The rollover to a child provides a way to transfer wealth and receive tax advantages. A UL policy could roll over to a child. At age 18, the child could surrender the policy. The child is likely to have little or no taxable income and, therefore, there will be little or no tax owing on the proceeds of the policy. Surrender cannot occur before age 18 or income attribution to the policyholder will apply. 7.9. Death of the policyholder. When a policyholder dies who is not the life insured, there is a deemed disposition of the policy. For tax purposes, death is treated much like an absolute assignment. Roll over to spouse. The policy can roll over to the spouse without tax consequences for the policyholder or spouse. Contingent policyholder. A contingent policyholder becomes the policyholder after the death of the original policyholder. He is also known as a successor policyholder. The original policyholder names the contingent policyholder. Probate, tax, on the policy gain is avoided by naming a contingent policyholder. However, any policy gain must still be reported on the tax return of the deceased policyholder unless the policy is rolling over to the spouse. Roll over to a child. A child may be named as successor owner. He will automatically assume policy ownership on the death of the policyholder. 7.10. Taxation of life insurance strategies. This section explores the tax implications of various strategies that can be implemented using insurance. Using the policy as collateral. Collateral assignment occurs when the policyholder, the borrower, uses the cash value in a policy as collateral to secure a loan from a third party, the lender. Such an assignment transfers the rights for the cash value and death benefit to the lender. If the borrower fails to repay his debt, the lender can surrender the policy and receive the CSV to cover the debt. If the borrower dies, the lender can receive the death benefit when the borrower is the same as the life insured. If the life insured is another person, the lender can take the CSV by surrendering the policy. A collateral assignment does not create a policy gain. The cash value of the policy continues to grow on a tax-sheltered basis during the period of the assignment. Borrowing for business use. A collateral assignment could be made on a loan for personal or for business use. Deducting premiums. All or part of the premiums may be tax deductible when a business loan is taken and secured by a collateral assignment. To be tax deductible, the loan must be from an authorized lender and the collateral assignment must be one of the requirements for the loan. The amount of the tax deduction is the lesser of the net cost of pure insurance. Premiums paid. If the death benefit is larger than the loan, the tax deduction is prorated as a percentage of the death benefit. Example. Hello Eyes borrowed $200,000 from a financial institution to expand her business. The lender required the collateral assignment of her $500,000 universal life policy, which had an adjusted cost basis, a CB, of $160,000 and a cash surrender value, CSV, of $250,000. Hello Eyes paid premiums of $12,000 annually, with an NCPI of $3,200. Because Hello Eyes' policy is for $500,000 but the loan is only for $200,000, she can only deduct 40% of the NCPI. Percentage of NCPI deductible is emailed to $200,000 divided $500,000 or 40%. So, she can deduct $1,280 as a business expense. Deduction is equal to 40% times $3,200 or $1,280. Annuitizing the cash surrender value, CSV. To annuitize means to transfer value from a life insurance policy to an annuity which will provide an ongoing series of income payments, either for a fixed term or for life. Annuitizing a policy is equivalent to canceling or surrendering a policy. Thus, when a policy is annuitized, there is a policy gain, equal to CSV minus ACB. If the policyholder is disabled. As a tax relief to individuals who are totally and permanently disabled, when a policy is annuitized, the policy gain can be spread over all annuity payments. This can reduce tax payable on the policy gain as a result of the policy gain being taxed at a lower rate because the marginal tax rate over the annuitization period will likely be lower. Partial surrender. It is possible to use only part of the CSV for an annuity. This is considered a partial surrender with a prorated policy gain. Leveraging a life insurance policy. This is known as an insured retirement strategy. It is where retired policyholders leverage their existing insurance policies to create a source of tax-free retirement income. Collateralizing the cash surrender value, CSV. The strategy is based on the ability of the policyholder to take a loan and provide the policy as collateral in a collateral assignment. Under an insured retirement strategy, the policyholder negotiates a series of annual loans, where each loan is secured by the policy's CSV. Each loan is tax-free to the policyholder. Therefore, it does not form part of taxable income. This appeals to those who wish to keep their income, and corresponding marginal tax rate, low. On the death of the life insured, the loan amount is repaid to the lender by the death benefit, excess above the debt is paid to the beneficiary. Interest paid or capitalized. Interest will be charged on loans made to the policyholder. It may have to be paid annually. Alternatively, the lender can allow for the interest to accumulate and be paid from the death benefit. This is known as being capitalized. Interest paid annually reduces the sum the policyholder receives. Capitalized interest reduces the sum the beneficiary receives. Charitable giving. By assigning a new or existing policy to a charity or naming a charity as the beneficiary of a new or existing policy, the policyholder receives the benefit of a charitable donations tax credit. Charitable donations tax credit. A donation to a registered charity results in a charitable donations tax credit. The credit is non-refundable. Tax credits can reduce income tax. A lower credit applied to the first $200 of donations, the credit is larger on amounts over $200. Spouses can combine their donations to avoid doubling up on the lower tax credit rate. Limits apply to the amount that can be claimed. During life, the limit is 75% of net income. It can be claimed up to 5 years after the donation is made. In the year of death, the limit is increased to 100% of net income. It can be claimed for the year of death and the year before. Example. Mahmoud lives in New Brunswick, where the provincial tax credit on charitable donations is 9.39% on the first $200, and 17.95% on amounts over $200. Last year he donated $2,000 to his favorite registered charity. It was his only donation. He was able to claim a total of $893.88 as a charitable donations tax credit, calculated as follows. Federal tax credit on first $200 is equal to $200 times 15% or $30. Federal tax credit on balance is equal to $2,000 minus $200 times 29% or $522. Provincial tax credit on first $200 is equal to $200 times 9.39% or $18.78. Provincial tax credit on balance is equal to $2,000 minus $200 times 17.95% or $323.10. Total federal and provincial tax credits is equal to $893.88. Mahmoud can deduct this from the total income tax he would otherwise have to pay. Note, the federal tax credit rate is 15% on the first $200 of donations and 29% on donations over $200. The federal tax credit is the same regardless of where one resides in Canada. The provincial tax credit will differ depending on the province where the policyholder resides. Assigning a new insurance policy to a charity. A brand new policy can be assigned to a registered charity provided the charity is willing and able to take ownership of it. However, because it has not had time to develop a cash value, there is no charitable donation. The policyholder does not receive a tax credit. If the policyholder continues to pay premiums on the policy after the assignment, the premiums paid become eligible for a tax credit receipt. This is true for both permanent and term policies. Assigning an existing insurance policy to a charity. An existing policy can be assigned to a registered charity provided the charity is willing and able to take over ownership of the policy. If so, a tax receipt will be issued. Equal to CSV or fair market value of the policy, or for premiums paid after assignment, if the donor continues to pay the premiums. Since term insurance has no CSV, the assignment of an existing term policy will not result in a tax receipt. An absolute policy assignment is a deemed disposition for tax purposes. Thus, at the time of assignment, the policy gain is determined, CSV minus ACB, and is taxable to the policyholder. Naming a charity as the beneficiary. Naming a charity as beneficiary provides a tax receipt to the policyholder in the amount of the death benefit that is paid out when the life insured dies. The policyholder will not get a tax receipt for the premiums paid on the policy after naming the charity as the beneficiary. When the policyholder is the life insured, the tax receipt can be used by the executor to generate a charitable donations tax credit for the year of death, or the immediately preceding year. Managing taxes upon death. Life insurance is often used to provide the funds to pay for the taxes that become due upon death. Taxes that are triggered by death include tax on capital gains, tax resulting from the collapsing of registered plans, RRSP, RIF, taxes due on the estate, and probate fees. Using life insurance proceeds to pay these taxes means the estate is saved such costs. Therefore, the value of the estate is enhanced for its inheritors. Agents must be able to estimate taxes on death to ensure life insurance coverage is adequate if the purpose of the insurance is to pay taxes and reduce the tax burden of the estate. It is recommended that agents review the module, Life Insurance Taxation Principles, to ensure they are familiar with these tax principles. Chapter 8, Business Life Insurance. 8.1. Potential impacts of death on a business. While death is often thought of as a purely personal event, unexpected or premature death can also have a devastating impact on some businesses, especially small and startup businesses that are dependent on their employees for their continued success. The death of a business owner or employee who is key to a business can have a significant negative effect on the overall success of the business. These effects may include the following: loss of skills, creditor demands, family interference, equality for family members, and capital gains tax. Loss of skills. Many businesses have an employee, or a combination of employees, whose skills are vital to the business. The employees may have long-term knowledge of the business, expertise, or ideas that others do not have, and this knowledge and experience may also be difficult to replace. Such a person is instrumental to business success. This is the person who is called a key person, or key employee. Examples of key persons may include highly skilled craftspeople, charismatic salespeople, or an influential vice president. Death of a key employee can bring about the collapse of a business if revenues decline as a result of the death. Example: Monica is a talented architect who works for a company specializing in the design of professional offices for lawyers and surgical specialists. The owners of the firm believe that about 30% of their business is due to the clients who specifically seek out Monica's talents. Monica's death would have a significant impact on the company's revenue. Creditor demands. Businesses may take on loans in the form of demand loans, which have no fixed term or set duration. Instead, a demand loan must be repaid to the lender on its request, as long as any required notice is provided. Death of a key employee can make lenders very nervous. They may demand repayment of a loan and/or refuse additional loans because of the uncertainty of future revenues. Example: Cooper was the senior sales director for an advertising firm and he has just died. Before his death, he was responsible for bringing in about 50% of the firm's new business. The company recently took out a $500,000 demand loan to completely revamp their IT infrastructure to allow them to develop new holographic ads. They were relying on Cooper to drive the sales needed to pay back the loan. However, when the bank heard about Cooper's death and saw the company's latest sales figures, they recalled the loan and demanded repayment in full. Family member interference. Businesses created as partnerships or private corporations may have more than one owner. For example, Abid and his brothers Amir, Farid and Danush own a company that imports Persian rugs. They each own a 25% share in the business. Problems may arise if one owner dies and their family member or members inherit the deceased owner's share of the business. To continue the example above, if Farid dies unexpectedly, his wife Gohar would inherit his shares. Those inheritors may not be familiar with the business and may have unrealistic expectations for profitability and distribution of revenue. To continue the example, Farid never revealed any details about the business to Gohar, who expects dividends to be paid quarterly. However, if dividends are paid quarterly, money will not be available in the business to buy more inventory. Without inventory, the business will be ruined. An inheritor may be willing to sell their newly acquired share of the business but at a selling price that is unreasonable and unrealistic for the other owners to pay. To continue the example, Gohar may be willing to sell the share of the business she inherited from Farid. However, with no knowledge of the business, she sets a price that is too high. The remaining shareholders refuse to meet her price. Family hostility ensues. Example: Jason, Ivan, and Connor were the joint owners of Restful Solutions, a funeral home that caters to the upper class of society. Jason died without a will and he was survived only by Mason, his 24-year-old son. Mason is a troubled young adult with a history of petty theft and drug use. Mason inherited Jason's ownership interest in Restful Solutions. He showed up drunk at the funeral home shortly after his father's death and loudly announced his intention to take over his father's role in the business. When Ivan and Connor tried to tell him that it was not a suitable role for him, he demanded $1,200,000 for his share in the business. Equality for family members. A parent who is a business owner will, most probably, want to treat all his children fairly when it comes to the distribution of his estate. It is important to note that treating children fairly does not mean treating them exactly the same, or identically. Creating a fair distribution can be a challenge when children have differing expectations, but is especially important when planning business succession. Parents may need to be creative in order to put plans in place that treat all children fairly. Example: Christina is the sole owner of a very successful garden center, Hibiscus, which is an incorporated company worth about $1.5 million. Christina has 2 children who are in their 20s. Harry shares his mother's passion for gardening and has worked at the garden center since the age of 10. Nancy is a doctor and has never had any interest in the business. Christina would love for Harry to carry on the business if she dies, but she worries about treating Nancy fairly. Christina's other assets are limited to about $400,000, and she feels it would be unfair to leave the business to Harry while only leaving $400,000 to Nancy. Capital gains tax. When a Canadian taxpayer dies, they are deemed, for tax purposes, to have disposed of their property at its fair market value immediately prior to death, unless a spousal rollover applies. Shares of a business may roll over to a spouse without tax consequences. Shares received by any other person may be subject to capital gains tax. In the case of an active and prosperous business, where shares are not left to a surviving spouses, this can result in a significant tax bill payable at the death of the business owner, on their final tax return. The capital gains tax that would be payable is calculated as follows. Taxable capital gain is equal to the fair market value of business shares minus the adjusted cost base times 50%. Tax owing is equal to the taxable capital gain times MDR. Example 1. Fair market value of business is equal to $1 million. Adjusted cost base is equal to $100,000. Capital gain is equal to $900,000. Taxable capital gain is $450,000, 50% of capital gain. Tax owing if MTR is 40% is $180,000. Example 2. Lori owns a 20% interest in a business corporation that she wants to pass on to her daughter, Olivia, when she dies. The shares currently have an adjusted cost base, a CB, of $100,000 and a fair market value, FMV, of $600,000, so if she dies today, this would result in a taxable capital gain of $250,000, calculated as $600,000 minus $100,000, times 50%. If her marginal tax rate is 50%, this would result in an income tax liability of $125,000. If her estate cannot pay that income tax and her daughter cannot either, then her executor would be forced to sell some of the shares to pay the tax bill. 8.2. Business types. Businesses may be structured 3 ways: sole proprietorship, partnership, or corporation. Sole proprietorship. A sole proprietorship is the least formal structure of the 3 structures that are available. It has one owner who personally pays all expenses and personally earns all income. The sole proprietor is usually the operator of the business, and the death of the sole proprietor could have a catastrophic impact on the business. The business itself is not a separate entity from the sole proprietor and has no adjusted cost base, and assets of the business, such as product inventory, become part of the owner's personal estate at death. Partnerships. A partnership is a business that is owned by 2 or more people who have the common purpose of earning a profit. Each owner has a partnership interest. There are several forms a partnership interest can take. They are A partner who receives a share of partnership income and is jointly and severally responsible for partnership debt and liabilities. A passive or silent partner who participates financially but is otherwise uninvolved. A general partner who is required in a limited partnership to be personally responsible for partnership debt and liabilities. A limited partner who is found in a limited partnership and has no responsibility for partnership debt and liabilities. Note that a partnership must always have at least one general partner. A partnership cannot be composed entirely of limited partners. A partnership interest has some of the same attributes as a corporate share. It has a value. It has an adjusted cost base. It can have a capital gain or loss. It can be bought, sold, or bequeathed, given through a will, on death of the partner. From a tax perspective, each partner must report their share of net partnership income on their personal tax return. Because a partnership interest may give rise to a capital gain upon the death of a partner, a tax liability may also arise at the partner's death. The impact of this tax bill can be devastating unless it is anticipated through careful planning. Corporations. A corporation is a legal entity in which shares of a corporation are created. The individuals who receive or buy those shares are the shareholders of the corporation. The corporation is separate and distinct from the shareholders, who are not personally liable for the debts and liabilities of the corporation, unless they personally guaranteed those debts. Shareholders, if they are directors of the corporation, may be held personally liable for the company's income taxes and any amounts that are deducted at source from payroll, such as employment insurance and Canada Pension Plan premiums, and employee income tax withholdings. Income received by the corporation may be paid to shareholders as salary if the shareholder is employed by the corporation and as stock dividends to all shareholders. Like policy dividends, stock dividends are not guaranteed. The corporation's shareholders do not report the company's net income on their tax return. Instead, that net income is taxed in the corporation, and after-tax corporate profits are either retained in the corporation, increasing share value, or are paid out to shareholders in the form of dividends. Shares have value and an adjusted cost base that can lead to a capital gain or loss when they are sold. As with a partnership interest, the resulting tax liability can be significant and should be considered during planning. Public versus private corporations. There are some significant differences in the tax rules for public and certain private corporations. Shares of a public corporation are traded on a stock exchange such as the TSX. Shares of a private corporation are not publicly traded. They are issued to employees and others with an interest in the business. A Canadian-controlled private corporation, CCPC, is a private corporation that resides in Canada, is Canadian-controlled, and is not controlled by a public corporation. CCPC shares are also called qualified small business corporation shares because they may qualify for a capital gains exemption. There are specific rules that set out how a company may qualify for a capital gains exemption, but these rules are beyond the scope of this discussion. Capital gains exemption. Shares of a CCPC may qualify for the lifetime capital gains exemption, LCGE. The exemption also applies to qualified farm and fishing property. The LCGE was increased from $750,000 per taxpayer to $800,000 in 2014. That sum is to be indexed for inflation for years after 2014. A taxpayer may use the LCGE to eliminate or reduce capital gains that are realized when qualifying shares are sold. The LCGE reduces taxable capital gains. The formula is capital gain minus LCGE, times 50% equals taxable capital gain. A shareholder who is able to take advantage of the LCGE will be able to reduce the capital gains tax that would otherwise be payable upon the disposition of shares in their business. Example. Gene was the sole shareholder of his sportswear manufacturing company, Killiman, which is a CCPC. When he died, the business had a fair market value, FMV, of $2,400,000 and an adjusted cost base, ACB, of $200,000. He left the business to his daughter, Yvonne. This deemed disposition resulted in a capital gain of $2,200,000. Capital gain equals $2,400,000 minus $200,000 or $2,200,000. Gene has never made use of the LCGE, so $800,000 of this capital gain is exempt from tax, leaving his estate with a taxable capital gain of $700,000. Taxable capital gain is equal to $2,200,000 minus $800,000 times 50% or $700,000. If Jean's marginal tax rate for the year of death was 45%, this would result in a tax liability of $315,000. Tax liability with LCGE is equal to $700,000 times 45% or $315,000. However, if he had not been able to take advantage of the LCGE, the tax liability would have been $495,000. Tax liability without LCGE is equal to $2,200,000 times 50% times 45% or $495,000. 8.3. Key person life insurance. Earlier we reviewed the concept of a key person in a small business and the potential negative impact if a key person dies unexpectedly. In order to protect against those negative consequences, a company can insure its key person. In this case, the company receives the death benefit. Example. A1 Industries has a salesperson, Elaine, who is a star. She alone is responsible for over 60% of revenues. A1 takes out a life policy on Elaine, naming itself as beneficiary. If Elaine died while a key person for A1 Industries, A1 could use the money to replace her and or shore up revenues during the search for her replacement. Split dollar arrangements. A split dollar arrangement is a method of sharing the cost and benefits of life insurance between two parties, such as a corporation and its key person. Typically, the agreement is between two parties and is used when more than one person or entity requires the benefits that can be provided by a life insurance policy. In common split dollar arrangements, a life insurance policy could be jointly owned by a key employee and the corporation for which they work. The specific arrangement could be structured in several different ways. For example, the employee could own the death benefit while the company owns and controls the cash value of the policy or vice versa. If it is a UL policy, the corporation could own the face amount and the key person own the death benefit greater than the original face amount, which would be paid to a beneficiary of the key person upon the death of the key employee. Alternatively, the corporation could own the death benefit up to the original face amount while the employee owns the policy's cash value and any death benefit in excess of the original face amount. This is a most common arrangement for key person insurance, as it provides the corporation with access to the death benefit in the event of the death of the key person while the employee is able to benefit from a tax-deferred investment vehicle. Each party to a split dollar arrangement pays a portion of the premiums in a way that recognizes their separate economic interests in the policy. In the final example, in which the corporation owns the death benefit up to the original face amount, the company's share of premiums will be tied to the reasonable cost of comparable term insurance coverage, while the employee pays the balance of the premium costs. Taxation of key person split dollar arrangements. There are no formal income tax rules governing split dollar arrangements. The administrative practice of Canada Revenue Agency has been to recognize the premium allocation between the employee and the corporation as a reflection of the fair market value of their respective interests in the insurance contract. Upon retirement or termination of employment, the ownership interest in the death benefit could be transferred to the departing employee. Depending on the fair market value, FMV, of the policy, the transfer might result in a taxable benefit for the employee. If the policy is surrendered, the employee would have to report a policy gain for the difference between the cash surrender value, CSV, and the employee's adjusted cost base, ACB, in the policy. As a requirement for borrowing. If the success of a business depends on the involvement of a key person, a lender may be reluctant to loan money to a business without the assurance of key person insurance. Key person insurance may have to be assigned to the financial institution providing the loan. A death of the key person would result in a death benefit paid to the lender in the sum of the loan. If a business requires key person insurance because a lender requires it, the business can deduct from its income the cost of premiums if a term policy is used. The net cost of pure insurance if a permanent policy is used. 8.4. Buy-sell agreements. A buy-sell agreement specifies what happens in a business with multiple owners if one owner dies. Important details for consideration are: who can, or must, buy the deceased owner's interest, the cost of that interest or how the cost will be determined, how to pay for the deceased owner's interest. Buy-sell agreements can also specify how a buyout is structured or if an owner wants to leave the business, retires or becomes disabled. Cross-purchase agreements. A cross-purchase agreement establishes the terms of the sale of a deceased owner's interest to the other owners. For a corporation with a cross-purchase agreement, in the event the agreement is triggered due to the death of an owner, the number of shares of the surviving owners increases, while their value remains the same. Example. The Best Company has 3 shareholders, Al, Bob, and Carl. They each own 100 shares. When Carl dies, Al and Bob buy Carl's shares according to the buy-sell agreement. Al and Bob each now own 150 shares, but each share is worth the same as it was before Carl died. A share redemption plan is a variation on the cross-purchase agreement. With a share redemption plan, the corporation buys the shares of the deceased owner, and the value of the shares of the surviving owners increases by the sum redeemed. The number of shares owned by the survivors does not increase. Example. Emily, Fatima and Gloria are the 3 shareholders of a small incorporated business specializing in health products called Forest Hair. They each own 100 shares, which are currently worth $10,000 per share. They recently entered into a buy-sell agreement in the form of a share redemption plan with the company, which says that, if any one of them dies, the company will redeem her shares for their current value as determined by the company's financial statements and will cancel shares redeemed by the company, of which the total will be 200. If Emily dies today, this means that the company will pay $1 million to her estate. Fatima and Gloria will still own 100 shares each, but because the number of outstanding shares will drop to just 200, they will now each have a 50% interest in the company, instead of the 33.33% ownership interest that they had before Emily's death. Why buy-sell agreements are important. A buy-sell agreement is essential among business owners to protect the business, other owners, and beneficiaries if one or more of the owners dies unexpectedly. A properly funded buy-sell agreement protects the surviving owners, the business, and the beneficiaries of the deceased owner. The critical elements of a buy-sell agreement are discussed below. Guaranteed buyer. A buy-sell agreement guarantees a sale of the shares, usually to surviving owners or the business itself. Guaranteed value. The price at which the sale is transacted is also guaranteed by the agreement. This is fair to the inheriting owner of the shares and prevents a fire sale in which the share price is deeply discounted simply to attract a buyer. Mandatory sale. A buy-sell agreement protects surviving owners from the unknown. Survivors know they will receive the shares of the deceased. With a buy-sell agreement, the estate must either sell the shares to the company itself, in a share redemption plan, or to the surviving owners, in a cross-purchase agreement. Guaranteed funding through life insurance. Life insurance provides an absolutely secure method of funding the purchase of shares from the estate of a deceased owner. How life insurance is used is described in the following sections. Crisscross insurance. An arrangement known as crisscross insurance is often used to fund cross-purchase buy-sell agreements. With a crisscross arrangement, each share owner or partner buys life insurance on all of the other share owners or partners. Example. The Best Company has 3 shareholders, Al, Bob, and Carl. Al owns a policy naming Bob as the life insured and another policy naming Carl as the life insured. Bob owns a policy naming Al as the life insured and another naming Carl as the life insured. Finally, Carl owns a policy on each of Al and Bob. The face amount of all policies must equal the value of each owner's shares or partnership interest. Example. Al, Bob, and Carl each own 100 shares valued at $1 million. Al is the policyholder for one policy naming Bob as life insured and another policy naming Carl as life insured. The face amount of each policy is $500,000. Therefore, if Bob or Carl dies, Al receives $500,000 tax-free to buy the shares of the deceased, and the other survivor also receives $500,000 tax-free, so that together they can pay $1 million for the shares of the deceased from his estate. Premiums for all policies may not be the same, since each owner may be assessed differently during underwriting. Because the insurance is not being used to secure a loan for business or investment purposes, the premiums are not a deductible business expense. Example. Jack and Alfred each own 50% of the 200 shares of Jackal Incorporated, a frozen dessert company. They implemented a buy-sell agreement funded with crisscross insurance. Jack died shortly thereafter. The overall process would look like this. 1. Jack and Alfred pay the premiums for life insurance on each other. 2. Jack dies, and his 100 shares transfer to his estate. 3. The insurance company pays a tax-free death benefit to Alfred. 4. Alfred pays Jack's estate for his 100 shares. 5. Jack's estate transfers the 100 shares to Alfred, who now owns all 200 shares, or 100% of the company. Business-owned insurance. Instead of the crisscross arrangement, the business could buy life insurance on its owners. It will be the policy beneficiary. This arrangement has several potential benefits over policies purchased by the individual owners, as follows. When the business is the owner of the policies, it will be clear to all owners that premiums are being paid. The business pays tax at a lower rate than individuals, plus individuals are saved the premium expense. If there are more than 2 owners, it will generally be more efficient and more cost-effective for the business to own policies on each associate, compared to each owner purchasing policies on the other owners. If the cost of insuring each associate varies significantly between the associates, due to reasons such as age and health status, a business-owned option will ensure that the costs are shared equally. Note that if a buy-sell agreement will be funded by business-owned insurance and there are only 2 owners, a joint first-to-die policy may be appropriate. Role of the Capital Dividend Account, CDA. Business-owned insurance can be used to fund both cross-purchase buy-sell agreements and share redemption plans. In order to understand how business-owned insurance can be an effective business strategy, it is first necessary to understand how the capital dividend account works. The capital dividend account is a notional account, which only keeps track of inputs and outputs for tax purposes. A private corporation uses its CDA to record amounts it receives on a tax-free basis, such as the tax-free 50% of capital gains and death benefits received from an insurance policy. When the account has a positive balance, the corporation can pay a tax-free capital dividend to its shareholders. The dividend is subtracted from the balance of the CDA. Funding cross-purchase buy-sell agreements. When a corporation is the policyholder and beneficiary of a life insurance policy on the business owners as part of a buy-sell agreement, the death benefit in the event of the death of any of the owners is deposited to the CDA. It is then issued to shareholders as a tax-free dividend. If a shareholder uses a promissory note to buy shares from the estate of the deceased, the dividend pays off the promissory note. The deceased's shares are acquired by the survivors. Example continued. Suppose Jack and Alfred's cross-purchase agreement is instead funded by insurance owned by Jackal Incorporated when Jack died shortly thereafter. The overall process is 1. Jackal Incorporated pays the premiums for insurance on both Jack and Alfred. 2. Jack dies, and his 100 shares transfer to his estate. 3. The insurance company pays the tax-free death benefit to Jackal Incorporated, which is credited to its CDA. 4. Alfred pays Jack's estate for his 100 shares with a promissory note. 5. Jack's estate transfers the 100 shares to Alfred, who now owns all 200 shares, or 100% of Jackal Incorporated. 6. Alfred instructs Jackal Incorporated to pay him a tax-free capital dividend. 7. Alfred uses these funds to pay off the promissory note. Funding share redemption buy-sell agreements. The corporation issues a tax-free dividend from the CDA, which the survivors uses to buy shares from the estate of the deceased owner. The deceased's shares are acquired by the corporation. Example continued. Suppose that Jack and Alfred instead entered into a buy-sell agreement with Jackal Incorporated, structured as a share redemption plan, funded by insurance owned by Jackal Incorporated when Jack died shortly thereafter. The overall process would look like this. 1. Jackal Incorporated pays the premiums for insurance on both Jack and Alfred. 2. Jack dies, and his shares transfer to his estate. 3. The insurance company pays the tax-free death benefit to Jackal Incorporated, which is credited to its CDA. 4. Jackal Incorporated uses the funds to redeem the shares from Jack's estate, canceling the said shares, reducing the number of shares outstanding to 100. 5. Alfred still owns the remaining 100 shares, which represents 100% of the company. Chapter 9, Application and Underwriting. 9.1. Process Overview. Underwriting is the process an insurance company uses to assess the risk presented by the life insurance applicant. It is the process by which the insurance company determines whether it will accept the risk and issue the policy, and, if so, the premium that needs to be charged to insure that risk. As a general rule, the higher the risk presented by the life insurance applicant, the higher the premiums that will be charged to insure the risk. Underwriting is completed at head office level, but agent insights and observations are important to underwriters. The agent is sometimes called the eyes of the insurance company, as typically only the agent will have face-to-face contact with the insurance applicant. Underwriting is completed for both personal and group policies. Agent's role. The agent collects some of the information needed to assess the risk. That information is supplemented by other sources consulted by the underwriter. Completing the application. The agent ensures information on the application is complete and accurate. The applicant understands what will happen if information is incomplete or inaccurate. The identity of the applicant and life insured is as stated by comparing name, date of birth, and appearance against government-issued ID. Signatures are true by witnessing the signatures on the application. The application is complete when all information needed has been provided, and the application is signed by the applicant and witnessed by the agent. The agent's role in helping the client complete the application is sometimes referred to as field underwriting. Underwriting. The completed application is sent to the underwriting department. The underwriter initially assigns the life insured the mortality risk of an average person. The underwriter then compares the life insured against many medical, financial, and lifestyle criteria. The purpose of the comparison is to assign the life insured to the most appropriate risk class. If the comparison shows the life insured has a low mortality risk, and their application is for a standard amount of insurance, then a policy is usually issued quickly. If the comparison shows the life insured has a higher mortality risk, or their application is for a non-standard amount of insurance, then a decision about whether a policy will be issued is not made until additional information can be assessed. Issuing and delivering the policy. The agent personally delivers the policy to the policyholder. The agent continues the underwriting process by ensuring the medical, personal, and financial status of the policyholder and life insured have not changed since the application was made. The agent must not deliver the policy if there is any indication of a change between application and delivery. 9.2. Application. The agent helps the applicant to complete the application. Spending time with the applicant may reveal aspects of the individual that are not apparent from the written form. The agent will want to share any information that can affect the risk assessment with the underwriter. Policy details. An application typically begins with the type of coverage the applicant wants to receive. Applicant or policyholder. The applicant is the person who wants to buy the policy, and who will be the future policyholder if the policy is issued. When the applicant will not be the life insured, the name of a contingent or successor owner is required. This owner becomes the policyholder if the original policyholder dies. Life insured. The applicant must identify a specific person as the life insured. An applicant may or may not be the same person as the life insured, but in most cases, the applicant will also be the life insured. A joint life policy names two life insureds and must further specify whether the death benefit will be paid when one dies, that is, a joint first to die policy, or on the death of the second, that is, a joint last to die policy. Beneficiary. The beneficiary receives the death benefit when the life insured dies. The beneficiary can be the applicant, any other individual, a group of people, a trust, a business, or a charity. Note that the applicant may only be the beneficiary if they are not the life insured. When a beneficiary is not named, proceeds are paid to the estate of the policyholder. A contingent beneficiary can be named who would receive the death benefit if the original beneficiary has died. Beneficiaries can be changed by making a written request to the insurer. The exception is when the beneficiary is irrevocable. An irrevocable beneficiary cannot be replaced unless the beneficiary gives their permission to be replaced. Sometimes an irrevocable beneficiary designation is required to comply with a court order for the child or spousal support. Type of policy. One application may serve for many types of policies. The UL applicant may have additional choices to make on the application to select how mortality deductions will be calculated, for example, yearly renewable term or level cost of insurance, and how the death benefit is calculated, such as whether the account value is to be received at death. Both UL and whole life applicants will usually be provided with a document that contains an illustration of policy benefits. UL sells illustrations project values for the deposits, mortality charges, investment Z plus account value, and cash surrender value and death benefit for each future year. Whole life illustrations for participating policies. Project dividends. The illustration that corresponds to the application must be attached to the application and signed by the applicant to demonstrate that the applicant has been shown how the policy works. Riders and supplementary benefits. If the insurance company allows policyholders to select additional riders and supplementary benefits, such as a family coverage rider, these additional riders and benefits are also selected on the application form. Typically, additional riders and benefits may only be selected when the policy is issued. Premium options. The payment schedule must be selected for premiums, monthly, quarterly, semi-annually or annually. Dividend options. Par whole life policyholders have a choice as to how dividends will be received. This choice is made on the application between cash, premium reduction, accumulation, paid-up additions, and term insurance. About the applicant. The attention of the insurance company focuses on the applicant for their ability to pay premiums, named insurable interest, justification for the amount of coverage, and history of insurance applications. Financial ability. To be assured the applicant can afford the premiums, the application may request details on the applicant's occupation, or prior occupation if retired, employer, income from all sources, and net worth, that is, the applicant's assets minus their liabilities. Insurable interest. An insurable interest is a policy requirement. It exists when the death of the life insured will cause the policyholder to suffer a financial loss, or fail to make a financial gain. Therefore, the policyholder needs to have an insurable interest in the life insured. An insurable interest is created by a policyholder who is also the life insured, and who will suffer a financial loss by their own death. Therefore, they have an insurable interest in their own life. The lives of a policyholder's spouse, child or grandchild, employee, person who financially supported by the policyholder, or anyone else in whom the policyholder has a financial, or pecuniary, interest. Anyone who consents in writing to the insurance on their life. Note that the insurable interest must only be present at the time the policy is issued. If the relationship between the policyholder and the life insured changes such that the insurable interest no longer exists, the contract is still valid. Example 1. When Isabel and her husband Justin had their first child, Justin bought a $500,000 20-year term life insurance policy on Isabel's life. Isabel and Justin divorced a few years later and Isabel has since remarried. Justin no longer has an insurable interest in Isabel's life. The existing policy remains valid, but Justin would likely not be able to buy any additional coverage on Isabel's life. Example 2. Justin's next-door neighbor, Caleb, is an adventurous person who has a passion for extreme sports and travel. When Justin heard that Caleb was planning to go on a solo snowmobile expedition to the North Pole, Justin joked that he should buy life insurance on Caleb's life. However, Justin does not have an insurable interest in Caleb's life, so the only way he could buy insurance on his life would be to obtain Caleb's written consent. Justification of amount of coverage. Insurance is intended to restore the person who has suffered a financial loss due to death to the position they would otherwise enjoy if death had not occurred. Insurance is not intended to provide a way for the person to profit from the death of the life insured. The amount of coverage must be reasonable for the circumstances of the policyholder and beneficiary. Example. Frank and Susan are both 30 years old, and they have 3 children, all under the age of 5 years old. Susan stays home to care for the children while Frank earns a salary of $250,000 per year. They have a $350,000 mortgage with a 20-year amortization. Another couple, Jack and Jolene, are 46 and 42 years old, and they do not have children. Jack earns $40,000 and Jolene earns $25,000. They rent their home and have no major debts. Susan and Jolene both applied for $7.5 million of life insurance coverage on their husbands. In all likelihood, the underwriters would consider $7.5 million of coverage on Jack's life to be excessive, and they would refuse to issue a policy for that amount. However, they would likely agree that the amount is reasonable in Susan's case, considering Frank's income and young age, Susan's lack of income, their mortgage debt, and the fact that they have 3 young children who require ongoing support. Insurance application history. Underwriters will also consider other policies that exist or for which an application has been made. This ensures the total amount of coverage is reasonable. About the life insured. The risk to the insurance company stems from the health of the life insured, as well as any activities that might result in death. As a result, the insurance application is designed to gather as much information about the life insured as possible. Personal information. Personal details about the life insured needed to complete the application include name and any former name, such as a maiden name, date of birth, address, social insurance number, country of birth, nationality or immigration status, employer and occupation, and details of any bankruptcy. Lifestyle questions about the life insured include hobbies, interests, and sports participation, travel, past and future plans, smoking habits including tobacco products, marijuana and its derivatives, and smoking substitutes, alcohol and drug use, driving history, and criminal charges and convictions. Medical information. Health details involve information about conditions, treatments, medications, family health history, and previous pregnancies. Questions require a yes or no answer. Yes answers lead to more in-depth questioning. The following information will also be taken: height and weight, personal doctor's name, and most recent medical consultation, its reason, and outcome. Example: when Rebecca was filling out her life insurance application, she answered yes to the question that asked, "Have you ever had or been investigated or treated for conditions involving your heart or blood vessels?" Because she had once visited the emergency room complaining of chest pain and shortness of breath. Later in the application, she was asked to provide details about the incident, including the name of the hospital and attending doctor, the types of tests he performed, and the diagnosis. Incomplete or erroneous information. Truthful answers must be provided or the policy can be voided. Material facts are facts that affect underwriting. Mistake. Mistakes may occur inadvertently through a misunderstanding or carelessness. A material mistake can lead to the policy being voided during its first 2 years after the issue or reinstatement. For example, inadvertently confusing months and days, that is, writing 0306 instead of 0603, is unlikely to affect underwriting. However, misstating age by years would affect underwriting. If 2 years pass without discovering the mistake, the policy stands as being incontestable unless fraud has been committed. Example: Christina recently filled out a life insurance application. The application accidentally listed her birth year as 1954 instead of 1945. This mistake is material because the risk of death increases significantly as the life insured ages. When it asked her to specify her most recent visit to a physician, she listed her annual checkup that occurred 9 months ago. She forgot to mention that she met with her physician 3 months ago to get a flu shot. This mistake is not material because getting a flu shot is unlikely to impact the underwriter's evaluation. Fraudulent misrepresentation. Fraud occurs when false information is provided to intentionally misrepresent the life insured in order to receive a policy, or receive a policy with a higher death benefit or lower premium. When fraud is discovered, the policy is void even if the 2-year contestability window has passed. Smoking is one habit that applicants persistently lie about. If discovered, the life insurance company may void the policy and refund premiums paid. Adjust premiums or the death benefit to reflect what is accurate given the smoking habit. Example: when Eric was traveling in Peru several years ago, he contracted a parasite that left him seriously ill. After spending several days being treated in hospital, he was discharged with a prescription for more antibiotics and was told that he should follow up with his family doctor when he returned home because there could be long-term complications, including organ damage. Eric recovered quickly and he never bothered to see his family doctor. When he later filled out a life insurance application, he knew he had some health issues that might concern the insurance company and that could result in higher premiums. He purposely neglected to disclose the incident in Peru. He decided that because it happened outside the country and he paid for it out of pocket, there was no way the insurance company could find out about it. 3 years later, Eric suffered sudden liver failure and died during surgery. The liver damage was eventually linked to his experience with the parasite in Peru. Because Eric made a fraudulent material misrepresentation, the insurance company was able to void the policy even though the 2-year contestability period had passed, and they did not pay the death benefit. Incomplete information. A policy application must be complete. If it is not, the underwriter will return the application. Policy issue will be delayed. Agents' comments. Agents are encouraged to comment on the applicant and life insured from their personal knowledge or observations. 9.3. Temporary Insurance Agreement, TIA. A temporary insurance agreement, TIA, provides insurance coverage while the policy is being underwritten. The agent issues the TIA. There is no guarantee a TIA will be issued. Requirements for coverage. The TIA requires the policy application to be completed. A minimum of 1 month's premium. Completion of a separate TIA application. A negative, no, answer to a short list of health questions on the TIA application. The life insured to be in the approved age range, roughly 15 days of age to 70 years of age. Coverage limits. Coverage of the TIA is typically limited to the lesser of a fixed dollar amount. The policy face amount. Suicide is excluded from coverage. Coverage duration. Coverage begins as soon as the application is completed or when medical proof is provided. The TIA remains in force until the earliest of the date it expires, usually 60 to 90 days after the issue. The date the actual policy takes effect. The date notification is received by the applicant that their application has been denied by the insurance company. The date the underwriter decides the TIA must be revoked and informs the applicant in writing. The premium that accompanied the application is returned if the application is denied. Agent's responsibilities. An agent must not issue a TIA if the agent believes the policy itself will not be issued. The premium is not provided with the application. The agent's observations lead to any doubt about the insurability of the life insured at standard rates. The underwriter who is processing the application may also revoke the TIA by advising the applicant in writing and returning the premium. Example. Richard is a life agent and he has just helped Arlene complete an application for life insurance. Arlene is diabetic and has high blood pressure. She admitted that she smokes regularly and Richard noticed that she had a persistent cough, which he duly noted in the agent's comments section of the application. Given the concerns about Arlene's health, Richard should not issue a temporary insurance agreement. 9.4. Underwriting by the insurance company. Once the insurance company receives a completed application, its underwriter begins the task of evaluating the risks posed by the life insured. Underwriting guidelines. Each insurance company has its own guidelines for underwriting. The guidelines establish standards and set out key elements that must be considered. When the standards are not met, usually more information is needed to assess the risk. For example, Claude is defined as morbidly obese according to the weight tables for standard risk. Claude may be required to undergo medical exams to substantiate his insurability for the amount of insurance he is applying for. The insurance company may have separate guidelines for medical, non-medical and financial underwriting. Agents may find it helpful to review the guidelines so they can help clients set realistic expectations about the outcome of their application. Example. Chandra is a life insurance agent and he recently helped his client, G9, complete an application for life insurance. He noticed that she reported a family history of diabetes and that she had recently lost a substantial amount of weight. Because he was familiar with the insurance company's underwriting guidelines, he was able to tell her that it was highly likely that the underwriters would request more information and require her to submit to a medical exam. He also warned her that she might not qualify for standard rates and that there was even a possibility that the underwriters would reject her application. Attending Physician's Statement, APS. An APS is provided by the personal physician of the life insured upon request by an underwriter. The insurance company contacts the physician and pays any fees for the statement. The physician returns the completed APS to the insurance company. The APS is a more detailed record of medical history, current health, and future health expectations. It usually addresses a specific medical problem or condition. Medical exam. The underwriter may request a medical exam, especially if a large amount of insurance coverage is being applied for or if the life insured is older. The exam may include a range of physical tests, depending on indicators. For example, suspected drug use may lead to the request for a urine test, heart problems may call for an electrocardiogram. The insurance company pays for all tests, regardless of who performs them. Usually, the medical exam is performed by a medical practitioner who works for an independent paramedical company. For high-value policies or if there are complex medical concerns, the underwriter may require the exam to be performed by a licensed physician or may order special tests, such as a cardiac stress test. Medical Information Bureau, MIB. The MIB exchanges medical information about applicants between insurance companies. The MIB is a membership of insurance companies, and most life insurance companies in Canada and the US choose to belong to the MIB. An applicant must give permission for their information to be shared with the MIB. When someone applies for life insurance at a MIB member company, they must be informed about the nature of the MIB and they must also sign a release that authorizes the insurance company to search for information about them on the MIB and to share any applicable details of their application with the MIB. An underwriter reports medical and non-medical issues to the MIB, where they are coded and stored. The MIB makes that information available to future underwriters when the same applicant applies for another policy or policies. MIB data can lead to an underwriter requesting substantiating information from a doctor or other sources. The MIB data in isolation cannot be the reason to deny a claim or apply a higher, rated, premium. Example. Ernie was living in Ontario when he applied for life insurance with ABC Insurance Company last year. On his application, he indicated that he had previously experienced a heart attack and had 2 related surgeries. He was also a heavy smoker and overweight. His application was declined. This year Ernie moved to Alberta and again applied for life insurance with XYZ Insurance Company. This time, he decided not to mention any of his heart problems, thinking that his health records would not be transferred between provinces. Also, he claimed to smoke only socially, a few cigarettes a month. He had also lost all of his excess weight, so he felt much more confident that his application would be approved. When Ernie had applied for insurance with ABC Insurance Co., they reported his heart problems to the Medical Information Bureau, MIB. When the underwriter at XYZ Insurance Company started working on his application, he searched the MIB database for any previous applications by Ernie. The MIB alerted him to the fact that another insurance company had reported that Ernie had heart problems and was a heavy smoker. While XYZ Insurance Co.'s underwriter could not use this as a basis for denying Ernie's application, it did prompt him to request a copy of Ernie's past medical records, and he also required Ernie to undergo a full medical exam, including various heart-related tests. Based on those results, the underwriter declined his application. Motor Vehicle Record, MVR. A motor vehicle record, MVR, provides details of the life insured's driving history. Poor driving habits are directly correlated to a higher risk of death. The underwriter will have an interest in violations, accidents, drunk driving charges, license suspension, and points. Statistics have shown that a person's driving record directly influence their risk of death. As a result, infractions such as failing to use a seatbelt or speeding may often cause a life insurance policy to be rated, resulting in much higher premiums. Inspection Report. An inspection report is completed by an independent contractor by a telephone interview, more commonly, or personal visit, less commonly. It focuses on non-medical issues that need more details or investigation, such as personal finances or dangerous hobbies. An inspection report usually focuses on non-medical issues and could include questions about the life insured's habits, for example, smoking or tobacco use, alcohol consumption. Finances, for example, income or estimated net worth. Occupation, for example, confirmation of employment, nature of duties. Driving record, for example, history of speeding tickets, careless driving, and avocation, for example, participation in extreme sports or hazardous travel. Requests for clarification or more information. Unclear or incomplete information will require the underwriter to ask for more information. This slows down underwriting. Financial underwriting. Just as medical underwriting establishes evidence of good health, financial underwriting establishes financial health, that is, the ability to pay premiums and the need for coverage. Life insurance companies provide a maximum amount of coverage based on how the coverage would be used if the life insured died. If used for income replacement, coverage may be set at a multiple of earned income. This multiple typically declines with age. If used for estate planning, coverage may be tied to net worth. If the policy is for a university student, coverage may be tied to the intended occupation. People who are not Canadian citizens. Different underwriting criteria may apply to those who are not Canadian citizens. Permanent residence. A permanent resident has been granted permission to live and work in Canada without any time limit on their stay. Permanent residents are generally treated for underwriting like Canadian citizens, except they may have to provide a copy of their permanent resident card. A permanent resident who has been in Canada for less than 1 year may have to provide extra medical proof of insurability. A permanent resident who frequently visits their home country may face a rating for premiums or exclusion of coverage when at home. Awaiting permanent residency. Those who have not been granted permanent residency may not be eligible for coverage. If coverage is available, its maximum may be linked to occupation. For example, a doctor could qualify for up to $5 million in coverage, while a nanny could qualify for up to $250,000. A dependent spouse or children of the life insured may qualify for a percentage of the coverage on the life insured, for example, 50% of the coverage of the life insured. Additional underwriting information may be required linked to medical and/or financial factors. International students. International students are those from other countries who study in Canada. They do not usually qualify for coverage. Frequent travelers. Those who travel frequently may be deemed a higher risk depending on the frequency of travel, where they go, and how long they go. Travel to certain countries may be excluded from coverage. For example, a person who frequently travels to Afghanistan may find that their death benefit will not be paid if they die in Afghanistan. Avocations. An avocation is a hobby or activity voluntarily undertaken outside work for personal enjoyment. Common high-risk avocations include parasailing, scuba diving, backcountry snowboarding and skiing. Participation in high-risk avocations will require an underwriter to assess how frequently the life insured participates, the location and timing of their participation, expertise in the avocation, and past accidents or certification violations. 9.5. Risk classes and their impact on premiums. Recall that when evaluating the risk of the life insured, the underwriter starts with a baseline, for example, 100, and then adds to or subtracts from this amount after evaluating each risk factor, based on how the life insured compares to the standard person of the same age. When this evaluation is complete, the underwriter can assign the life insured to a risk class. Each insurance company will have their own class system and a number of classes, but general categories are discussed below. Standard. Every insurance company will have a standard or normal risk category, which represents the average person. The life insured in this risk class is offered a standard premium. Preferred. Insurance companies usually have one or more preferred categories, for people who present an exceptionally low risk. The life insured in this risk class is offered a lower than standard preferred rate premium. Rated. Rated risk is above average risk but still insurable. The life insured in this risk class is offered a higher than standard premium. Exclusions. Excluded risk is one particular factor that must be excluded from coverage. The life insured in this risk class is offered a premium for their risk class, that is, standard, preferred or rated, with an exclusion for death arising from the identified factor or event. For example, Nick is a standard risk except he frequently scuba dives. Nick's policy specifies that the death benefit will not be paid if he dies scuba diving or as a result of scuba diving. Example. Michael immigrated to Canada from Lebanon 35 years ago, and he is a Canadian citizen. He recently applied for life insurance, and the underwriter noted that Michael was in exceptionally good health and would normally be eligible for preferred rates. However, he also noted that Michael returns to Lebanon every other year to visit his parents and siblings, who still live in that country, which often experiences periods of armed conflict. Rather than declining Michael's application, the insurance company issued a policy at preferred rates with an exclusion for travel to Lebanon. This means that if Michael dies while in Lebanon, The death benefit will not be paid. Upgrading risk class. Once a policy is issued, the risk class cannot be changed to a higher rating. For example, a preferred cannot become a standard. However, it is possible to improve the life insured's risk class if the reason for the rating no longer exists. For example, Josh switches jobs, from being a fireman to being a computer programmer. He could request his policy risk be reassessed. If the risk factor of his new job is lower, his premium may go down. The reason that a life insurance company would consider a request for a reassessment of premium costs is competition within the industry. If the rating is not removed, the policyholder may be tempted to cancel the policy and apply for a new policy, with a lower or no rating, at a competing company. Example. When Bill first applied for life insurance, he was a commercial fisherman, which is one of the most dangerous occupations in terms of risk of death. While he was able to obtain insurance, the policy was rated and came with a hefty premium. Once his daughter was born, Bill left the fishing industry and he now works as a janitor for the local school board. Bill should ask his insurance company if the hazardous occupation rating can be removed from his policy, with a corresponding reduction in premiums. Declined. When a risk is too great, the application is declined. A permanent decline will never be reconsidered. A temporary decline will be defined as a period of time that must pass before an application is made again. 9.6. Client factors that may affect premiums. One of the components that affects life insurance premiums is the net cost of pure insurance, NCPI, which in turn is based upon the risk that the life insured will die during the period of coverage. This risk is evaluated during the underwriting process that was just discussed. There are many risk factors that are common to all people. This section examines those risk factors and their impact on the policy's premiums. Age. The net cost of pure insurance is one of the factors used in determining the cost of insurance premiums. This cost is based on the risk that the life insured dies during the period of coverage. Risk of death increases with age. Therefore, premiums increase with age. Note that this relationship is not linear. The risk of death increases at a greater rate as a person ages, particularly after the ages of 60 or 65. For impact of age at issue on premiums, see diagram 9.1. Attained age. This concept was introduced in Chapter 2. Remember from Chapter 2 that depending on the insurance company, the attained age of the life insured may be the age of the life insured on their last, nearest or next birthday. Gender. Women generally live longer than men. Therefore, men have a higher risk of death. Premiums for male life insureds are generally higher, all other factors being equal, than for females. For impact of gender on premiums, see diagram 9.2. Health status or risk class. In section 9.5 above it states that higher risk equals higher premiums. Each life insurance company will have its own system for classifying risk. Most companies will have between 3 and 5 risk categories. For impact of health class on premiums, see diagram 9.3. Hazardous occupation. More dangerous jobs have a higher risk of death and correspondingly higher premium than jobs with a lower degree of physical risk. Hazardous lifestyle. Whenever and, however, risk is introduced, it is accommodated by charging a higher premium unless the risk is so extreme that it leads to the policy being declined. 9.7. Company factors that may affect premiums. Recall that, once a policy is issued and the premium is set, premiums cannot be increased. Therefore, if a life insurance company experiences higher costs than anticipated, or lower revenues, it can only charge higher premiums on new policies it issues. Mortality costs. If life insurance company underwriters do a poor job of risk assessment, the company may pay more in death benefits than anticipated, or pay sooner than anticipated. The amounts actually paid out in benefits are the mortality costs for the company. This can drive up premium prices for the company. The insurer may lose its competitive edge in premium pricing. If an insurance company has higher mortality costs than it expected, it may raise premiums on new policies to compensate. Administration costs and expenses. An insurance company is a business that, like all businesses, has expenses. These include expenses such as marketing, underwriting, issuing and administering policy documents, and investigating and processing claims. An insurance company must earn enough to pay its costs through its investment of premiums and premium charges. A company with higher costs will charge higher premiums. Investment returns. As described above, investment returns are key for the payment of expenses. Low investment returns, whether current or expected, can mean higher premiums. 9.8. Reinsurance. As noted previously, maximum limits apply to the amount of coverage available in a life insurance policy. Such maximums are called the insurance company retention limit. A company insures individuals to its retention limit. If coverage is more than that limit, a reinsurance company assumes the balance of the coverage. For example, A+ Insurance has a retention limit of $25 million. If a policyholder wants $30 million in coverage, Z+ Reinsurance provides the extra $5 million in coverage. The policyholder pays the premium to the insurance company and the insurance company pays a premium to the reinsurer. On death, the insurance company pays the full death benefit and the reinsurer pays its share to the insurance company. As per the preceding example, the life insured with $30 million in coverage dies. A+ Insurance pays the beneficiary $30 million and Z+ Reinsurance pays $5 million to A+. Example. John applied for a $15 million life insurance coverage with Insure for Life Company. Insure for Life's retention limit is $10 million, but they were still interested in placing the policy. They contacted Dresser Co., a reinsurance company, to underwrite the additional $5 million of coverage, and Dresser agreed. Insure for Life issued a $15 million policy to John, and he pays the full premium directly to them. Insure for Life, in turn, pays a premium to Dresser. If John dies, Insure for Life will pay the full death benefit of $15 million, but then it will receive a death benefit of $5 million from Dresser. 9.9. Issuing the policy. The underwriting process does not stop with the issuing of the policy, it continues right up until delivery and acceptance of the policy. Delivery. Delivery is another step in the underwriting of the policy. Delivery should be made by the agent, in person, to assess any last-minute changes in the risk posed by the life insured. Changes could be financial, due to a change in occupation or other financial issue. Medical, due to a change in health. Lifestyle, due to a new interest or activity or discontinuation of an avocation declared on the application. The agent should review with the policyholder the policy. Grace period, the 30 days following premium due date in which the premium can be paid before the policy lapses. Incontestability clause, the 2 years following policy issue in which the policy can be voided by the insurance company if material misrepresentation occurred. Suicide exclusion period, the 2 years following policy issue in which the death benefit will not be paid if death is by suicide. The policy should only be delivered after satisfying these conditions, receiving confirmation in writing that there has been no material change in the circumstances of the applicant, and receiving any outstanding premiums. If the agent suspects or confirms a change, all policy documents should be returned to the insurance company for further consideration and potentially new underwriting. 9.10. Acceptance. The policyholder must accept the policy by signing and dating an acknowledgement provided by the insurance company. After acceptance, client's review period begins. During this period, the client may exercise their right of rescission. Rescission is the legal right to be freed from a contract. For insurance, the policyholder must receive a minimum of 10 days to exercise this right, therefore, the client has a 10-day right of rescission period. During this period, the client should review the policy and its details. Note that the right of rescission for the insurance company is 2 years, not 10 days as for the client. For the insurance company, this is known as their 2-year contestability period. 9.11. Group life insurance. Underwriting of a group policy is done on the group as a whole. The underwriter examines the characteristics of the group, such as the mix of age, gender, and occupation in the group, and compares one group against the company's experience with similar groups to assess risk and determine premiums. Basic group life insurance. If there are no membership classes, such as different benefits for different classes of employee, one cost, per $1,000 of coverage, applies to every group member as the premium. When membership classes exist, each class has its own premium rate. Premiums are usually recalculated annually. Additional coverage. As discussed in group insurance, additional life insurance coverage may be offered to group members, for example as units of term insurance. Individuals who apply for additional coverage are usually required to provide proof of insurability and underwritten on an individual basis. Creditor life insurance. Creditor life insurance is a type of group insurance. Underwriting for creditor life insurance is superficial, based on a questionnaire requiring yes or no responses. A yes response to a question that requires a no answer, or vice versa, could lead to more in-depth assessment. When creditor insurance is offered through a financial institution, not an insurance company, the applicant must complete the application without assistance from any employees of the financial institution, as those employees are not insurance agents. Coverage is usually limited to established maximums unless medical underwriting is performed. Premiums are set at a fixed monthly rate based on the loan outstanding and the age group of the life insured. Post-claim underwriting. Post-claim underwriting occurs after a life insured has died. It assesses whether the life insured qualified for coverage. The underwriting may determine that a death benefit should not be paid. There is no recourse for survivors if it is not paid. Chapter 10, Assessing the Client's Situation. 10.0. Assessing the Client's Situation Case Study. The concepts in this chapter, as well as Chapter 11, will be illustrated using a case study focusing on Derek and Becky's family, who are introduced below. Derek and Becky's family case study. Derek and Becky are 47 and 38 years old respectively, and they have been married for 2 years. Derek and his previous wife, Susan, aged 44, divorced 4 years ago, and they share joint custody of a son, Jordan, age 8. Prior to marrying Derek, Becky was a single mother to Anya, aged 4. Derek formally adopted Anya when they got married. Derek and Becky have just had a child together. Robbie is 2 months old. Derek and Becky are concerned about securing their financial future in the event that Derek dies, and they have approached a licensed life insurance agent to help them assess their insurance needs. 10.1. Assess the family dynamics. Many people use life insurance to provide financial support for their families upon their death. Agents need to understand their client's family dynamics before being able to advise how to best provide that support. Current spouse. Many people use life insurance to provide financial support for their families in the event of their unexpected death. There is an expectation that when people are married, either as legal or common law spouses, the income earners in the family will arrange their affairs so that their spouse, and children, will be supported financially if they die. The amount of support would depend on the nature of the relationship and the surviving beneficiary's own financial capacity. For example, if there is a primary income earner, that is, a single income household, that individual would become the proposed life insured in a life insurance policy, and the spouse would be the beneficiary. In dual income households, the surviving spouse may earn enough to be fully self-sufficient if one spouse dies. Dependent versus self-sufficient. A sole income earner for the family will usually need to replace his or her entire income for the surviving spouse's use or to help cover childcare expenses if the spouse were to return to work. If the life insured and spouse both earn an income, each spouse's earning power will be taken into consideration when determining the total amount of financial support that would be needed. Case study. Derek is employed full-time as the vice president of industrial design for a manufacturing company, with take-home pay, that is, income after taxes and deductions, of $8,400 per month. Becky currently stays home caring for Jordan, Anya, and Robbie, but she intends to return to work as a human resources manager once Robbie is in school full-time, about 6 years from now. She anticipates that her take-home pay will be around $4,500 per month. However, Derek feels that, if he dies, he would prefer that Becky would not have to return to work until Robbie is 18, if at all possible. If Derek were to die today, the family would obviously suffer from the loss of his income and, even if Becky could return to work immediately upon his death, her income would be insufficient to maintain the family's current standard of living. Support obligation to ex-spouse or spouses. An ex-spouse may require financial support. The obligation for financial support may end if the ex-spouse remarries. Court-ordered insurance. When a court demands financial support for an ex-spouse, the court order often will specify that sufficient life insurance, naming the ex-spouse as beneficiary, be obtained by the supporting spouse to satisfy the support obligation. Without life insurance, the ex-spouse could make a claim against the estate of the deceased spouse to seek financial restitution. The life insurance death benefit must be calculated based on the monthly support obligation multiplied by the period of time for which support has been ordered. For example, the monthly support obligation is $1,000 and it is ordered to last for 16 years. The policy death benefit must be a minimum of $192,000, $1,000 times 16 times 12. Case study. Derek and Susan used a mediator to develop their spousal support agreement, which specifies that Derek must pay spousal support of $500 per month until Susan reaches age 65 or she remarries, whichever occurs first. While their support agreement was not court-ordered, Derek told his life agent that he wants to ensure that the $500 in spousal support is paid monthly to Susan even if he dies. Minor children. Minor children should be provided for, at least until age 18, or if the child is enrolled full-time in a post-secondary institution and is still a dependent, then the support obligation would be required to continue until the approximate age of 22 or 23, the completion of the first post-secondary degree. The financial need may encompass both living expenses for the children and the costs of post-secondary education. Case study. Derek wants to ensure that Becky has the financial resources she will need to raise their children if he dies prematurely. In addition to their living expenses, he would also like to ensure that all 3 children will have enough money to pay for post-secondary education. Current care arrangements. A stay-at-home spouse and a caregiver to children have economic value. Consider the cost of paying for full-time childcare. The death of a stay-at-home parent could also have a huge financial impact on the family. Case study. Becky is not currently earning an income, but her role as the stay-at-home parent is vital to the family. If she died, Derek would have to pay for someone else to take care of Jordan, Anya and Robbie so that he could continue to work. In addition, the family would not benefit from the income Becky hopes to earn when she returns to work in 6 years. Child support to ex-spouse. There is a legal requirement to provide financial support for children from prior relationships who may be in the full custody or partial custody of the ex-spouse or ex-partner. Court-ordered insurance. A court may order a parent to pay child support and, as part of the court-ordered divorce or separation agreement, require the supporting parent to obtain life insurance so that in the event of death of the supporting parent the support obligations will continue to be satisfied until the child reaches adulthood, is no longer legally considered a dependent. If the court order for child support is silent on the issue of how support is to be paid in the event of the death of the parent who is paying support, the surviving parent may have a claim for support against the estate of the deceased on behalf of the child or children. Case study. As part of their mediated divorce agreement, Derek agreed to pay child support to Susan for Jordan, in the amount of $1,000 per month, until Jordan is 19 years old. While it was not specifically addressed in their agreement, Derek wants to ensure that Jordan continues to benefit from this support even if he dies. Other dependents. Depending on the life-insured situation, there may be other family members who would suffer financially if the life-insured were to die. Disabled family members. A family member who is disabled may require significant financial support and care during his or her life. With such financial burdens, the policyholder must plan for the estate to provide the necessary support. Case study. Derek and Becky are fortunate that all of their children appear to be healthy and they expect the children to eventually become financially self-sufficient. Derek's older brother, Peter, and his wife Janine are not as fortunate. Their 8-year-old son, Chase, has a severe developmental disability and he will never be able to live independently. However, Chase has a normal life expectancy, so Peter and Janine need to consider how to provide for him over a time frame that could extend 50 years or even more. Aging parents. Financial support for parents may be another need to be factored into the life insurance coverage calculation. Depending on the parent's financial situation, this care may be financial, physical, or both. 10.2. Assess the employment situation. The agent must determine whether income is earned as an employee, a business owner, or from retirement savings, as loss of income is one of the biggest financial risks associated with death. Employee. The following factors should be taken into consideration for an employee and their insurance needs. Current income. Income that is earned on a regular basis, take-home pay, that is, the amount received after deductions, needs to be taken into consideration as part of the insurance needs analysis. If income is lost due to the death of a primary income earner, insurance can restore the lost spending power for survivors. The amount needed for this purpose is calculated as net income multiplied by the number of years until planned retirement age. Income earned by an employed spouse may reduce the total sum needed. Future income potential. What is likely to happen with the job in the future? Income is likely to increase, due to increased wages, better job prospects, and to keep pace with inflation? If the desire is for the family to be able to maintain the same standard of living after the death of the life insured, then the insurance needs analysis needs to factor in expected future income and inflation. One possible solution to this need would be a universal life policy which, through the investment account, can provide an opportunity for investment growth and thus an increasing death benefit. Case study. Derek is a vice president with take-home pay, that is, pay after all tax and other deductions, of $8,400 per month. He expects to be promoted to Chief Operating Officer, COO, within the next 2 years, which would increase his take-home pay to $9,500 per month, with the potential for larger bonuses as well. This might suggest that he would want the flexibility to increase his insurance coverage in the future. Job stability. Does the life insured have a record of job and income stability? Job stability of both spouses is important to ensure future premiums can be paid. If income could be variable, then a policy should be offered that allows the life insured to temporarily reduce premiums without reducing coverage. Case study. While Becky plans to return to work once Robbie is in school full-time, she is worried that her time away from the workforce and her outdated technology skills may make finding a new job difficult. She may even have to spend time updating her training before she is employable. This makes the replacement of Derek's employment income even more important if he dies. Group benefits. The family of an income earner with group benefits may lose those benefits when the income earner dies. Replacing the benefits provided by group benefit coverage will comprise one need that should be included in the life insurance need analysis. When it comes to calculating how much coverage is appropriate in a personal policy, a life insured who is a member of a group life plan should reduce the amount of personal coverage needed by the amount of the group benefit. For example, Guy receives life coverage at work to a maximum value of his salary of $220,000. Therefore, his need for personal coverage could be calculated and reduced by $220,000. Likewise, if his group policy provides survivor income benefits, this would also reduce coverage required from a personal policy. Case study. With 3 young children, Derek and Becky expect to have many dental and medical bills over the next 15 or 20 years. Becky already suffers from some arthritis. As a result, she wears custom orthotics and sees a physiotherapist regularly. All of these expenses are currently covered by Derek's plan, but that coverage would cease upon his death, increasing the strain on the surviving family's cash flow. Business owner. For life insureds who run a business, that is, self-employed, how the business is structured needs to be considered when going through the insurance needs analysis, as it may impact the amount and type of life insurance required. Sole proprietorship. A business operated as a sole proprietorship often ceases to exist with the death of the sole proprietor and may be subsequently sold. Upon the death of a sole proprietor, net income is reported on the final tax return, with the potential for tax owing on income earned from the sale of any business assets. Case study. While neither Derek nor Becky is self-employed, Derek has 3 siblings, Peter, Mark, and Kimberly, who all own their own businesses. The examples in this section will focus on their businesses. Derek's brother Peter offers strategic management consulting services as a sole proprietor. His business income fluctuates from year to year, but on average he receives consulting income of $120,000 and he has related business expenses of $15,000 per year. He reports the net business income of $105,000 on his personal tax return. If Peter dies, his family will no longer benefit from this self-employment income. His business-related assets are minimal and include some home office furniture and computer technology, all of which have depreciated in value since their purchase. If Peter dies, he will be deemed to have disposed of all of his business assets for their fair market value prior to death. Because they have decreased in value, this will not result in a capital gain. Corporation. A life insured who owns a private corporation may earn income in the form of a salary and/or taxable dividends. When the life insured dies, his shares are deemed to have been disposed at their fair market value. This could lead to a capital gain, which, if the business is a qualified small business corporation, can be reduced by the lifetime capital gains exemption. A corporation can survive the life insured and continue beyond death, and if the life insured's shares have been bequeathed to a beneficiary, he or she will continue to receive the dividends. Case study. Derek's sister, Kimberly, is one of 2 equal shareholders in InterSavvy Incorporated, a successful internet research company structured as a Canadian-controlled private corporation, CCPC. She receives an annual salary of $180,000 per year, as well as dividend income averaging $50,000 per year. The company has 12 other employees, and Kimberly is confident that the business will survive even if she dies. However, she is worried about the tax implications of the deemed disposition of her corporate shares upon her death. Even after using the LCGE of $800,000, she expects that the unsheltered taxable capital gain upon death will be in the order of $500,000. She is also worried about how her family will manage if she dies and they can no longer benefit from her annual salary of $180,000. Partnership. A life insured's interest in a partnership is deemed to have been disposed of at its fair market value when the life insured dies. Again, a capital gain can result. However, it cannot be reduced by the lifetime capital gains exemption, LCGE, as the LCGE applies only to capital gains earned from the sale of qualified small business shares, or from fishing or farming property. Case study. Derek's brother, Mark, owns and manages several apartment building complexes in partnership with his 2 adult children, Aaron and Penny. Mark owns 50% of the partnership while Aaron and Penny each own 25%. Mark's share of profits last year was $140,000. His will leave his partnership interest to Aaron and Penny. Because this business is structured as a partnership, it does not qualify for the LCGE, and Mark is worried that the anticipated taxable capital gain of $400,000 upon his death will erode the rest of his estate, which he plans to leave to his wife, Michelle. Existing buy-sell agreement. A buy-sell agreement specifies that either the corporation or the other shareholders or partners to buy a deceased owner's interest in a company. The agreement would specify that the purchase would be done at a fixed price or a price based upon a predetermined formula. The owner may not leave the interest to an heir in their will when a buy-sell agreement exists. A share redemption plan is used if the corporation will buy the shares. A cross-purchase agreement is used if another shareholder or partner will buy the shares. The use of life insurance guarantees that funds will be available to buy the shares. Case study. Derek's sister, Kimberly, and Janet, who is the co-owner of InterSavvy Incorporated, are in the process of implementing a buy-sell agreement. This agreement specifies that if Janet dies, Kimberly will buy Janet's shares from her estate for $2 million, and vice versa. In accordance with their agreement, Kimberly must acquire $2 million life insurance policy on Janet's life, to ensure she has the funds to comply with the agreement if Janet dies. Business income stability and amounts. Similar to assessing the stability of employment income, in assessing life insurance needs, the stability of income from self-employment should also be assessed. Is income from the business reliable and regular? Is the business at risk of failing? This stability shows the ability to pay premiums or, alternatively, the need for insurance with flexible premiums. If insurance is intended to support a family, its amount should reflect how business income might increase in the future due to business growth. Recall that if the objective is to replace the business owner's income in the event of their death, the income to be replaced is the net, after tax or take-home pay, not the gross business income. Retirement. Retirement often means that the need to replace employment income may end. Time to retirement. Many people, especially professionals, work past age 65. Therefore, their survivors may continue to have a need for income replacement until the time the life insured is expected to stop work. Retirees may also need life insurance, especially if death will cause a retirement pension to be reduced for a surviving spouse. Case study. Derek plans to retire at age 65. He would like to ensure that he has enough life insurance to replace his income for the next 18 years if he dies prematurely. Retirement income sources. The potential sources of retirement income should be considered when going through an insurance needs analysis. A defined benefit pension plan would provide survivor benefits. Pension plan legislation requires plans to provide the surviving spouse with a pension after the plan member dies. Its amount is generally between 60% to 66% of the amount that would be received by the plan member. With a defined contribution plan, if the plan member used the money to buy an annuity, the survivor might not receive a benefit. Government retirement pensions. If the life insured is entitled to receive CPP and OAS, survivors may be eligible to receive survivor benefits from both the Canada Pension Plan, CPP, and Old Age Security, OAS, in addition to his or her own CPP and OAS benefits. 10.3. Assess current financial situation. The life agent needs to get a clear picture of the life insured's existing financial situation, in order to identify assets that are available to meet estate needs, debts that may come due at death, the amount of income the household receives now, and how this might change upon the death of the life insured, how much of current income is spent to meet current needs, and how much is saved, and how much cash flow is available to meet life insurance premiums. Assets. What assets are available to contribute to financial need? Assets are the property owned by an individual, either personally or in a form joint tenants with right of survivorship. A life insurance needs analysis should consider all property owned by the life insured that could be used to address estate objectives, may have a corresponding liability, such as a mortgage against a home, and could result in a tax liability for the estate. The agent must assess the value of all assets and differentiate between assets that could be sold to increase the survivor's base of capital, and assets the survivor would prefer not to sell. For example, a survivor might have no emotional attachment to a rental property owned by the deceased. Selling the property could contribute significantly to the survivor's need for income. However, the survivor might be very reluctant to sell a family heirloom clock despite its value in the tens of thousands of dollars. Liquid assets. A liquid asset is cash or property that can be quickly and easily converted to cash, without any loss in value. For example, a checking account is a liquid asset. Liquid assets are needed to pay immediate expenses created by death, such as funeral and or burial costs and personal debts. Liquid assets will also provide an immediate contribution towards income replacement. When there are not enough liquid assets to cover expenses, fixed assets, such as real estate and vehicles, have to be sold and sold quickly. Case study. Derek and Becky use their tax-free savings accounts, TFSs, to hold their emergency fund. They each have about $25,000 in their TFSs, invested in a combination of money market funds, Canada savings bonds and cashable guaranteed investment certificates, GICs. They also have $20,000 in their joint checking account. They only invest in their TFS as if Derek receives a year-end bonus. Fixed assets. Fixed assets are a valuable property whose sale will produce cash. They include real estate, vehicles, jewelry, expensive furniture, boats, etc. To attract a buyer and complete the sale quickly, the price of the asset may be reduced to less than its market value. In this case, it will contribute less to needs than previous planning may have indicated. Case study. Derek and Becky jointly own a house valued at $550,000, a CB of $425,000. Derek has a new car worth $45,000 while Becky's used family van is worth $10,000. Derek also owns a cottage valued at $600,000, a CB of $250,000, that he inherited from his father that he hopes to pass on to Jordan, Anya and Robbie someday. He also owns 3 vintage cars that could easily be sold for a total of $72,000, a CB $60,000, which he suspects Becky would sell upon his death. Investment assets. Investment assets generate and store wealth for future use, and are created by using savings to buy corporate shares, bonds, rental real estate, segregated funds, mutual funds, and exchange-traded funds. Other financial instruments. Investment assets may be held in a registered account, such as a registered retirement savings plan, RRSP, or a non-registered account. Registered accounts may roll over to a spouse without creating a tax liability. Non-registered accounts held in a joint form of ownership may also roll over to the other joint owner without a tax liability. Otherwise, if there is not a tax-free rollover, the full value of the investment will be included in the final tax return for the deceased. Thus, it is important to record the ACB and the fair market value, FMV, of investment assets, as well as the intended beneficiary. Case study. Derek has a non-registered investment portfolio in a diverse mix of equities. The portfolio has an FMV of $280,000 and an ACB of $162,000. It generates after-tax income of $7,200 annually. He has $89,000 in his personal self-directed RRSP, and he has been contributing to a spousal RRSP for Becky. There is $36,000 in the spousal RRSP, and Becky has her own RRSP worth $24,000. They only contribute to the RRSPs in years Derek earns a bonus. Pension entitlements. If the life insured or the spouse is a member of an employer-sponsored pension plan, current entitlements and survivor benefits under the plan should be factored into the insurance needs analysis. Case study. Derek is a member of his employer's DCPP. To date, his account is worth $180,000, including his contributions, those of his employer, and accumulated investment income. Becky is a designated beneficiary of this account. If Derek dies before retirement, the funds will roll over into a locked-in retirement account, which Becky can access upon reaching age 55. Case study summary of assets. Chapter 11 recommending an insurance policy will be using the information collected so far about Derek's and Becky's assets and is summarized in Table 10.1. Debts. A life insurance needs analysis must consider debt as well as assets. Assets may be owned outright or a creditor may be involved. Debt obligations must be taken into consideration since they increase the amount of insurance coverage needed, as creditors may demand repayment upon the death of the borrower. As well, the payments towards the debt limit the cash flow available to fund estate planning objectives. Just as assets are totaled for their contribution to net worth and income, so too must all debts be totaled. Mortgage. A mortgage is often the single largest debt of a homeowner. A mortgage must be discharged, paid off, before the property can be bequeathed. Spouses are usually co-owners and mortgagees of property. A surviving spouse must have the financial ability to continue mortgage payments. Often, the life insured will want to ensure the surviving family can continue to own and live in the family home, and when going through the insurance needs analysis will take this into consideration so that there is enough insurance to cover the amount owed on the mortgage. If adequate life insurance is not in place, a survivor might have to sell their home because they could not make mortgage payments. Case study. Derek and Becky have just renegotiated the $330,000 mortgage on their house, resulting in payments of $1,800 monthly over the 25-year amortization period. Given Becky's current lack of income, Derek would like the mortgage to be paid off if he dies. Credit cards and lines of credit. Insurance coverage should also be sufficient to pay off credit card debt and all lines of credit. Note that lenders may allow a credit card or line of credit accounts to remain open in the event of the death of one spouse if the account was held jointly, but may reduce the amount of available credit to reflect the surviving spouse's income only. Case study. Derek and Becky do not have a line of credit and, while they sometimes charge as much as $3,000 to their credit cards in 1 month, they usually pay the balance in full to avoid interest charges. Other loans. Loans extended by creditors, such as a loan taken out to buy a car, must usually be paid off on the death of the borrower. A life insured may also have an outstanding demand loan, which is a loan for which the lender may demand repayment in full at any time. Demand loans typically have no predetermined repayment schedule, and may only require the borrower to make interest payments. Demand loans are often used by investors to leverage their investments. Case study. Derek has a car loan with a balance of $41,000, with payments of $620 monthly for the next 72 months. He would like this loan to be paid off if he dies. Case study summary of liabilities. Chapter 11 recommending an insurance policy will be using the information collected thus far about Derek's and Becky's liabilities, summarized in Table 10.2. Tax liability upon death. A tax liability can arise upon death for income earned in the year of death. Capital gains on property inherited by someone other than the spouse. Probate taxes on property passed on through the will, except in Alberta and Quebec. The life insurance needs analysis should ensure there is adequate life insurance coverage for tax liabilities. Case study. Derek has a number of assets that have the potential to result in a tax liability upon death, depending on the designated beneficiary. Any non-registered property transferred to Becky can roll over, without triggering a taxable capital gain. Similarly, registered plans such as Derek's DFSA, RRSPs and pension entitlements can transfer into registered plans for Becky if he designates her as the beneficiary. Perhaps the biggest concern is the family cottage that he wants to pass on to the children. If he leaves the cottage to the children, either directly or through a trust, it could trigger a taxable capital gain of $175,000 based on its current value, calculated as FMV of $600,000 minus ACB of $250,000, times capital gains inclusion rate of 50%. If Becky decides to sell Derek's vintage car collection, this would also result in a taxable capital gain. Current expenses. Spending patterns could change when the life insured dies. Less may be needed for certain expenses. For example, there may no longer be a need for 2 cars. And more may be needed for other expenses, for instance if the surviving spouse must now pay for the cost of childcare that was previously provided by the deceased spouse. How expenses will change if the life insured dies should be taken into consideration when analyzing insurance needs. Summary of monthly expenses. Spousal support for Susan $500. Child support for Jordan, child, $1,000. Mortgage, principal and interest, $1,800. Car loan, principal and interest, $620. Property tax, home, $480. Home insurance and maintenance $330. Property tax, cottage, $370. Cottage insurance and maintenance $400. Utilities, phone and internet $440. Core insurance $340. Gasoline $300. Food $600. Derek's life insurance $20. Clothing and personal care $400. RESP contributions $450. Dining out and entertainment $150. Sports, fitness $160. Vacation $200. Total monthly expenses $8,560. Available cash flow. Cash flow equals net income coming in minus cash going out. Cash flow determines whether, and how much, cash is available for life insurance premiums. It is calculated as net income, that is, take-home pay, minus expenses. A positive cash flow means the family can afford to increase expenses, such as buying life insurance. Case study. With Derek's take-home pay of $8,400 per month, they appear to have a small shortfall of $160 per month. However, Derek has indicated that until he receives his anticipated raise in 2 years, he is willing to use the after-tax investment income from his non-registered investments, $7,200 per year or $600 per month, to cover the shortfall, as well as any required insurance premiums. While Becky and Derek both agree that it is important for her to remain home until Robbie is in school, they are looking forward to the day in about 6 years when she can return to work and bring in additional income. 10.4. Assess existing insurance. The next part of an insurance needs analysis requires the life agent to identify and assess any existing insurance in place. Individual insurance. What life insurance does the life insured already own? This could be a combination of personally owned policies, or coverage provided through a group life plan at work or through membership in an organization or association. If the life insured already has one or more individual insurance policies in place, the life agent should note the following. Type of policy is a term 100, participating whole life, non-participating whole life or universal life. Face amount, death benefit. What is the original face amount of the policy? For term policies, is the death benefit level increasing or decreasing? For participating whole life policies, are dividends used for paid up additions? For UL policies, is the death benefit level increased by the cash account value or cumulative premiums, or indexed? Cash surrender value, CSV, for UL and whole life policies, What are the policy's current CSV and adjusted cost base, ACB? Will surrender charges apply? How do the current values compare to the initial policy illustration? Policyholder who owns the policy and can make decisions regarding it? Is it owned by an individual or a corporation or partnership? Life or lives insured, is the life insured the same person as the policyholder? If there is more than one life insured, is it a joint first to die or joint last to die policy? Term of coverage: if it is a term life insurance policy, what is the term of coverage, for example? 5-year, 10-year, 20-year? Renewability and convertibility: if it is a term life insurance policy, is the coverage renewable upon expiry of the term? Can the policy be converted to whole life or universal? Until what age can the policy be renewed or converted? Beneficiaries: who is the beneficiary of the policy? Is the beneficiary designation revocable or irrevocable? If the policy names multiple beneficiaries, does it state how the death benefit is to be split between them? If the beneficiary is a minor child, does it specify what should be done with the death benefit until the child reaches the age of majority? Is the beneficiary a testamentary trust? Riders and supplementary benefits: what riders and supplementary benefits are included with the policy? For example, does the policy include a guaranteed insurability benefit, GIB, rider, which would allow the life insured to increase coverage in the future without providing proof of insurability? For whole life and UL policies, does the policy include a provision for paid-up additions, PUA? What are the coverage limits under the GIB or PUA riders? Does the policy include dependent or family life insurance benefits, and, if so, for what amount and who are the beneficiaries? Premiums: what are the premiums currently payable for the policy? For renewable term policies, what are the premiums upon renewal? For UL policies, what are the minimum and maximum deposits? Are the premiums payable for life or for a limited number of years? Are the mortality deductions based on yearly renewable term, YRT, rates or level cost of insurance, LCOI? Limitations or exclusions: does the policy exclude coverage for death resulting from certain causes or activities? Examples include death while traveling in a specific country, or death incurred while deep-sea diving. An accidental death policy may not cover death that results from illness or natural causes. Case study: when Jordan was born, Derek, who was 39 at the time, bought a 10-year term policy with a $250,000 level death benefit. Originally the policy named Susan as the beneficiary, but when they divorced he made his estate the beneficiary. The policy has a double indemnity rider for accidental death and is renewable and convertible to age 70. It does not include any other riders. His current premiums are based on standard health rates and are $250 per year. The policy is due to renew in 2 years. The annual renewal rates at age 49, 59 and 69 are $1,125, $2,625 and $6,875 respectively. Business insurance. Does the life insured have coverage through association with a business, such as key person insurance, or through ownership of a business? Note that business insurance may be structured so that the business is the beneficiary of any policy. Relationship to buy-sell agreement. A buy-sell agreement may specify that life insurance is required to be in place for each of the parties to cover the obligation for the surviving owner or owners to buy the business interest of a deceased owner or partner. The insurance may be purchased by the individual shareholders or partners or by the business itself. Type of policy. The buy-sell agreement can be based on term or permanent insurance. Term insurance will help minimize costs, while permanent insurance will ensure that coverage remains in place for an indefinite period of time. Also, with permanent insurance, the cash surrender value would be available to be used by the business. A policy used as collateral for a business loan can usually be term, with a period of coverage equivalent to the length of the loan. Ownership of policy and payment of premiums. The policyholder for a business policy may be the business. Under a cross-purchase agreement, the business owners buy insurance on the other owners personally. A key employee covered in a split-dollar arrangement will need to determine which portion of the death benefit, the face amount and any value in excess of the face amount, belongs to him or her and will be paid to their personal beneficiary. If the business wants to protect itself from the loss of a key employee while also offering the employee access to a tax-deferred investment vehicle, the business would own the face amount, and the employee would own the cash value. In this case, The business share of the premiums would be tied to the reasonable costs for comparable term insurance coverage, and the employee would pay the balance of the premiums. Group insurance. As noted above, group insurance can contribute a death benefit. The life insured may be the group plan member, or they may be covered as a dependent. Face amount. What is the group plan face amount? Coverage provided by the group plan must be analyzed for its basic death benefit. Possible increase in the basic benefit due to a link to salary or by length of service, or by accidental death. Possible decrease due to age. Option for an increase in coverage. Policyholder and conditions of membership. It is important to note that the group plan member is not the policyholder of the group policy and, therefore, has no control over whether premiums for the policy will be paid, whether the policyholder will continue to provide the plan. As a result of changes in personal circumstances or in the group plan, the life insured may fail to meet the conditions for continued membership in the plan, resulting in the death benefit is no longer available. End date and convertibility. When will group coverage end? There may be an end date to coverage under a group plan, for example if coverage ends at retirement. Conversion to a personal policy with equal, higher or lesser coverage may be feasible if the plan is terminated or the plan member retires. It may be possible to convert spousal or dependent coverage as well. Review Section 6.6. Case Study. Derek has group life insurance equal to 1 time his annual salary through his employer's group plan. It is convertible to the same amount of individual term coverage upon leaving the plan. Vulnerabilities. What are the weaknesses of the group plan? Its many limitations must be taken into consideration. Foremost among these is the limited amount of coverage, the lack of control for group plan members, and whether the policyholder might discontinue the plan. In addition, although coverage is usually convertible to an individual insurance policy, the premiums upon conversion are not guaranteed. Government benefits. While government benefits upon death are not usually sufficient to address all of an individual's insurance needs, they are still worth noting. Canada Pension Plan, CPP. Survivor benefits. Upon the death of a person who has contributed to the Canada Pension Plan, CPP, provided that the person meets CPP eligibility requirements, the person's estate or one or surviving family members may be eligible to receive one or more of the following benefits. Death benefit. This is a one-time lump sum benefit payable to his estate or beneficiaries. The death benefit cannot exceed $2,500. The actual benefit will be based on the deceased's contribution history. Survivor's pension. The amount that his surviving spouse can receive as a CPP survivor's pension depends on whether or not she is also receiving a CPP disability or retirement pension, her age at the time of his death and his CPP contribution history. The maximum monthly survivor's pension is $567.91 if the surviving spouse is under age 65, and $623 if she is 65 or older. 2014 amounts. If the spouse is over 65 and also receives her own CPP retirement pension, the maximum she can receive in combined benefits is the maximum monthly CPP retirement pension of $1,038.33, 2014 amount. Children's benefit. Children of a deceased eligible CPP contributor can receive a flat rate monthly benefit of $230.72, 2014 amount. If both parents die and they were eligible CPP contributors, the child can receive 2 children's benefits. The child must be under 18 years of age, or between the ages of 18 and 25 and enrolled in school full-time to receive this benefit. The person's estate, surviving spouse and children, or their guardians, must apply for these benefits. They are not paid automatically. Case study. Derek has been making the maximum CPP contributions for about 20 years and meets the eligibility requirements for survivor benefits. Quebec Pension Plan Benefits, QPP. What is the difference between CPP and QPP? QPP benefits are the same as CPP benefits except the death benefit is paid for the contributor's actual funeral expenses to a maximum of $2,500. Therefore, if funeral expenses were $1,000, the death benefit would be $1,000. Surviving spouses, younger than 45 with dependent children, receive a different sum as a survivor's pension. Table 10.3. Summary of CPP and QPP survivor benefits in 2014. CPP survivor benefits. Death, maximum one-time payment, $2,500. Survivor, younger than 65, $567.91. Survivor, 65 and older, $623. Survivor, 65 and older, combined with CPP retirement pension, $1,038.33. Children of deceased contributor, $230.72. UPP survivor benefits. Death, maximum one-time payment, $2,500. Survivor, younger than 45 and not disabled, no dependent children, $506.56. Not disabled, with dependent children, $814.23. Disabled, $846.94. Survivor, aged 45 to 64, $846.94. Survivor, 65 and older, $623. Survivor, 65 and older, combined with UPP retirement pension, $1,038.33. Children of deceased contributor, $230.72. Old Age Security, OAS, allowance for surviving spouse. Who receives OAS? While only contributors to CPP can receive its benefits, all Canadians who qualify receive OAS. The surviving spouse, between ages 60 and 64, of an OAS recipient, may receive an allowance to a specified maximum. It is reduced by $1 for every other $2 of income, meaning that the allowance is only paid to low-income surviving spouses of OAS recipients. Workers' Compensation, WC, benefits. Workers' compensation programs are provincially delivered programs to protect employees from financial hardship due to injury at work or occupational diseases. Employers are required to pay premiums into the program, at rates based on their own risk and safety records, in comparison with provincial averages. Each province has their own WC board, and the federal government has a separate WC board for federal employees. The benefits, paid to the surviving spouse or children, can vary widely from jurisdiction to jurisdiction, but typically include the following types of payments. Funeral costs, ranging from $4,000 to an unlimited amount. An immediate lump sum, ranging from $2,000 to over $100,000. Monthly pensions for the surviving spouse and or children that range from as little as $400 per month for a child to 85% of the deceased's net earnings for a surviving spouse with children. It is important to remember that these benefits are only payable if death is caused by a work-related accident or illness. 10.5. Identify client's priorities in the event of death. So far, this chapter has focused mainly on facts and numbers. However, the agent must also understand that the qualitative questions are as important. Family lifestyle. Planning should ensure that the lifestyle enjoyed by survivors would not be diminished by death of the proposed life insured, whether the husband, wife, partner, or parent. Some of the quality of life issues to be considered include: how and where will children be cared for? Is the surviving spouse likely to be dependent, or will he return to work? Is there a need for a surviving spouse to update their education and training to become employable? Will the family continue to live in its principal home? Should the mortgage be paid off? Is there a second home or homes to which the family is attached? Should planning be based on keeping that home in the family? Is there a family business with plans to pass it on to children? If so, how will the tax liability resulting from the deemed disposition on death be paid? Case study. Derek wants Becky to be able to carry through with their plans to have her stay at home until Robbie is in school full-time. At that time, he knows she will be ready to return to work, but her earnings will not be enough to maintain their current standard of living. Thus, he would like to ensure that she has enough money to replace his income for the next 6 years, plus enough to supplement her anticipated income to the same level, until retirement at age 60. He also wants all of their debts to be paid off if he dies. Derek wants to fulfill his commitments for spousal and child support for Susan and Jordan, and, while he believes Becky would honor his wishes, he would prefer not to have to involve her in these payments after his death. Finally, Derek wants to ensure that the title to his cottage can pass on to his children, by having enough funds in his estate to pay the income tax that would result upon his death. Final expenses. Funerals may be small, modest affairs or quite expensive. The agent needs to verify with the client the type of funeral the life insured would like to have, in order to ensure funds are available and sufficient to meet the desired type. Case study. Derek does not want an extravagant funeral. He believes $20,000 will be more than adequate to cover his final expenses. Plans for future. As part of the insurance needs analysis, people may want to think about the future. What events are likely to occur, and add financial strain. For example, the costs of post-secondary education, formal weddings, and long-term care are three considerable expenses. If the life insured has died before these events, will the survivor have enough money to pay, or contribute to, their costs? The death benefit may also be required to pay large lump sums as legacies and for charitable giving. Case study. Derek and Becky believe it is their job to prepare the children for adulthood by helping them afford a quality post-secondary education, without necessarily covering the entire cost. Beyond that, they have no intention of providing the children with capital for a home or business. They already contribute to an RESP for each child, and as long as he can ensure that his income will be replaced if he dies, Becky can continue to make these contributions. He believes that another $10,000 for each child will be sufficient to cover their educational expenses. If possible, Derek would also like to make a charitable donation of $100,000 to his local hospice if he dies, because this organization recently provided excellent end-of-life care to his father. Chapter 11, Recommending an Insurance Policy. 11.1. Evaluate the probability, severity, and duration of risks. It will be your job, as the agent, to assess the severity of risk, the probability that it will occur, and its financial impact. Table 11.1. Risk Assessment Matrix. Death. Probability. Low. Financial impact. High. Disability. Probability. Medium or high. Financial impact. Medium. Critical illness. Probability. Medium. Financial impact. Medium or high. Incapacity requiring long-term care. Probability. Low or medium. Financial impact. Medium. Medical or dental expenses. Probability. High. Financial impact. Low. Each person will have a different risk matrix and it will evolve over time with changes in life's needs and circumstances. Probability of death. The risk of death is based on the following factors: age, gender, health, lifestyle risks, current age and gender. As discussed in Chapter 1, women live longer than men. And, as is obvious, the chance of death increases with age. Table 11.2. Odds of dying for males and females. Age 10. Male. 1 in 11,111. Female. 1 in 12,500. Age 20. Male. 1 in 1,408. Female. 1 in 3,333. Age 30. Male. 1 in 1,351. Female. 1 in 2,703. Age 40. Male. 1 in 758. Female. 1 in 1,190. Age 50. Male. 1 in 332. Female. 1 in 508. Age 60. Male. 1 in 128. Female. 1 in 206. Age 65. Male. 1 in 79. Female. 1 in 128. Age 70. Male. 1 in 49. Female. 1 in 78. Age 75. Male. 1 in 30. Female. 1 in 47. Age 80. Male. 1 in 19. Female. 1 in 27. Age 85. Male. 1 in 11. Female. 1 in 16. Age 90. Male. 1 in 7. Female. 1 in 9. Age 95. Male. 1 in 5. Female. 1 in 5. Age 100. Male. 1 in 3. Female. 1 in 3. To determine the odds, simply divide 1 by the probability of death. Looking back at our case study from Chapter 10, which we will continue to reference throughout this chapter, Derek is currently 47 years old, while Becky is only 38. Based on the same data set that was used to produce Table 11.2, That is, an average for all Canadian males and females. Derek's probability of dying before his next birthday is 0.23%, which represents odds of 1 in 437. Becky's probability of dying before her next birthday is 0.07%, which represents odds of 1 in 1,408. Another approach is to present the probability of death occurring before a certain age. Personal and family health history. Health problems experienced by the individual, or conditions that appear to be genetic, may impact the probability of death. Case study. Derek's father and 2 of his uncles were diagnosed with type 2 diabetes before the age of 50. His father is still living at age 72, but both uncles died in their early 60s. While Derek is fine so far and of average health, he knows that he is overweight and that he is predisposed to develop the same disease. This will increase his odds of dying before his next birthday. Lifestyle risks. The lifestyle choices people make affect their probability of death, such as smoking, substance abuse, bad driving habits, frequent travel, especially to certain countries, hazardous avocations, financial impacts of death. It is essential for the agent to help the client understand who would be affected by the death of the client and in what ways. If income was lost, how would survivors support themselves? If a caregiver was lost, could the survivor afford the cost of care in order to go to work? If there are debts, such as a mortgage on the family home, how will they be repaid? How will income taxes resulting from the deemed disposition of property at death be paid? How will funeral expenses and other expenses relating to death be paid? Case study. The biggest financial impact associated with Derek's death would be the loss of his employment income, which currently amounts to $8,400 per month after tax. His death may also result in the calling of their $330,000 mortgage and his $41,000 car loan, meaning that payment would be required in full, and the passing of the cottage to his children may result in a tax liability of $175,000. Duration of risk. The insurance agent needs to understand how long will the financial ramifications resulting from the death of the client last. Some risks are of a limited duration, others are lifelong. For instance, a car loan may be paid off in 4 years. Child support obligations last until the child is at least 18 years of age or 22 or 23 if enrolled in post-secondary education and dependent, lifelong if the child is dependent due to mental incapacity or physical disability. Other risks. There are other risks aside from death that the client could be exposed to, such as disability, illness and unemployment, which may impact the client's ability to pay the premiums on an insurance policy. Risk of illness or disability. The risk of disability for 3 months or longer is higher than the risk of death for all age groups. Disability can have as great an impact on family finances as death. If disability means the person is unable to work and earn an income, financial hardship may ensue. This is particularly true for those who are self-employed or sole proprietors. Adding a waiver of premium benefit or a dread disease rider to a client's life insurance policy will help the client keep the policy in force should the client be unable to earn an income due to illness or disability. Risk of unemployment. What are the chances that the policyholder will lose his job and be unable to pay premiums? Job instability can be managed by choice of a policy with premium flexibility, such as a whole life policy with automatic premium loans or UL. 11.2. Insurance Needs Analysis, Income Replacement Approach. The insurance needs analysis is used to determine the correct amount of life insurance coverage that will replace lost income to the surviving family upon the death of an income earner. Case study. Derek is currently the sole income earner for the family. A life insurance needs analysis based on the income replacement approach would determine the value of the income that would be lost upon his death. If the life insured played an essential non-income earning role in the family, such as that of a caregiver, that individual's contribution can be expressed in terms of what it would cost to replace that service. Case study. Becky currently stays home to care for Anya and Robbie, as well as Jordan when he is with Derek. Recall that Derek and his ex-wife Susan share joint custody of Jordan. While Becky's death would not result in a loss of income, her role as caregiver still has economic value. A life insurance needs analysis based on the income replacement approach would determine the cost of replacing her duties as caregiver and homemaker. The income replacement approach bases coverage on 2 methods. 1. Capitalization of lost income, including services in kind, such as childcare. 2. Capital needs. These will now be explained. Capitalization of lost income. Under this approach, the insurance need is determined by calculating the lump sum amount of capital that would need to be invested to generate the lost income. Capitalized value equals annual income divided by rate of return. Calculations using this approach results in a higher insurance need. This method is also referred to as the capital retention method because it assumes that the principal always remains intact. It is only the income generated by investing the principal that is used by the beneficiary and not the principal itself. Thus, the income stream lasts in perpetuity. Case study. Derek currently takes home $8,400 per month. Assuming a rate of return of 5%, the capitalized value of his lost income would be $2,016,000, calculated as $2,016,000 is equal to $8,400 per month times 12 months, divided by 5%. This suggests that he should have about $2 million in life insurance. Impact of investment returns, inflation and income tax. The approach described assumes that return earned on the invested death benefit will remain constant over time. To protect against changing investment returns, a conservative interest rate should be used. Also, the approach so far fails to consider the impact of income taxes or inflation on income. Accounting for income taxes. Life insurance proceeds are not taxable when received. However, the resulting income from invested life insurance proceeds is taxable. In terms of income replacement, lost income may be expressed either as a growth salary, or an after-tax amount, and the capitalization of income should be calculated on the same basis. Thus, if the lost income is expressed as an after-tax amount, the interest rate used when calculating the capitalization of income should also be an after-tax amount, using an appropriate tax rate. The MTR should be used if the income amount is small, relative to the recipient's other sources of income, and the average tax rate should be used if the income amount is large. Case study. Derek has after-tax income of $8,400 per month or $100,800 per year. Therefore, the investment income earned on the death benefit needs to be calculated on an after-tax basis. The after-tax rate of return is calculated as follows. After-tax rate of return equals rate of return times 1 minus tax rate. Case study. If the investment return is 5% and average tax rate is 25%, the after-tax rate of return is 3.75%, calculated as 5% times 1 minus 25%. This means that, using the replacement of income approach, adjusted for income taxes, Derek would need $2,688,000 in life insurance, calculated as $8,400 per month times 12 months, divided by 3.75%. Accounting for inflation. Inflation is defined as the increase in prices over time. The effects of inflation result in a fall in the purchasing value of money. In other words, with the same amount of money, one can buy fewer goods now compared to 1 year ago. The approach also assumes that the income being replaced is fixed over time. In reality, this is not the case as an individual's salary usually increases over time. The following calculation for capitalized value addresses the issue which takes inflation into account. It is called the inflation-adjusted rate of return. The inflation-adjusted rate of return is equal to 1 plus return divided by 1 plus inflation rate, altogether minusing 1. If Derek's employment income increases at a rate of just 2% a year, the $8,400 per month he takes home today will increase to $10,240 in 10 years, which is a significant difference. As the inflation rate is 2% per year and the investment return is 5% per year, the inflation-adjusted rate of return is 2.9%, calculated as 1 plus 0.05 divided by 1 plus 0.02 minus 1 equals 0.0294. This means that using the replacement of income approach, adjusted for inflation, Derek would need $3,428,571 in life insurance, calculated as $3,428,571 is $8,400 per month times 12 months, divided by 2.94%. Accounting for income taxes and inflation simultaneously. Both income taxes and inflation will affect the amount of capital needed. The after-tax, after-inflation rate of return should be used in order to account for both factors. After-tax, after-inflation rate of return equals 1 plus after-tax return divided by 1 plus inflation rate minus 1. Case study. Previously it was determined that if the investment return is 5% per year and taxes are 25%, the after-tax rate of return is 3.75%. If the inflation rate is 2%, the after-tax, after-inflation rate of return is percent, calculated as 1 plus 0.0375 divided by 1 plus 0.02 minus 1 equals 0.0171. This means that using the capitalization of income approach, adjusted for income taxes and inflation, Derek would need $5,894,737 in life insurance, calculated as $8,400 per month times 12 months, divided by 1.71%. Weaknesses of the income replacement approach. The income replacement approach has the benefit of simplicity, but it fails to address what the survivors actually need. How long the lost income would have been generated if the life insured had not died, nor the life insured's desire to create or protect an estate. 11.3. Insurance needs analysis, capital needs approach. This approach is based on the actual needs of survivors for capital. It identifies all of the income and capital needs arising as a result of death and converts them into a capitalized amount at death. This approach starts by listing the surviving family's sources of income, then comparing them with their expenses, to determine if a shortfall exists. A shortfall is an indication of how much insurance coverage is needed. Income earned by survivors. Income may be earned from employment, pensions, investments, and government benefits. Case study. Becky does not currently work, and she does not expect to return to work for at least 6 years, at which time she believes that her take-home pay would be about $4,500 per month. However, Derek would feel better if he knew that she could manage the household financially without working until Robbie turns 18. Neither of them currently earns investment or pension income. If Derek dies, Becky would be eligible for a Canada Pension Plan, CPP, survivor benefit of about $550 per month, and all 3 of the children would be eligible for a CPP benefit of about $230 per month as children of a deceased CPP contributor. Derek wants to ignore any potential benefits his family could receive under his province's Workers' Compensation Board because there is no guarantee that his death will be work-related. Ongoing expenses. What expenses might continue after the death of the proposed life insured? Expenses can fall into 4 categories. Increasing expenses over time, such as property taxes. Decreasing expenses over time, such as childcare as children grow up. Level expenses that stay the same, such as a set dollar amount paid to a charity. Be eliminated, such as debts that would be paid off by the death benefit. Case study. Derek has indicated that he would like to see all of his debts paid in full upon his death, which means Becky will not have to worry about mortgage or car payments. Derek also wants to handle the support obligations separately, so they will not form part of Becky's budget if he dies. In addition, some of their expenses, such as gas, core insurance, and food, will decrease slightly upon his death. The table below shows a modified version of the summary of expenses that was provided in Chapter 10. Assessing the client's situation, showing both current expenses, and how they would likely change as a result of Derek's death. Summary of the family's monthly expenses, current and after death. Income shortfall. If the income is less than the expenses, then an income shortfall exists, calculated as follows. Income shortfall equals expenses minus income. Case study. Factoring in the CPP survivor benefits, $570 monthly for Becky and $230 monthly for the children. If Derek dies, the family would experience a shortfall of $2,890 per month, calculated as $2,890 is equal to $4,150 minus $570 plus $230 plus $230 plus $230. Capitalization of income shortfall. Once the shortfall is determined, the next step is to calculate the amount of capital that would be needed at death to cover the shortfall. 2 methods can be used. The capital retention method. The capital drawdown method. The capital retention method was demonstrated above and is used when the intent is to preserve the capital of the death benefit and replace income, where capitalization of shortfall equals annual shortfall divided by investment return. For greater accuracy, the investment return used should be the after-tax and inflation-adjusted rate of return. Case study. Previously it was determined that if the inflation rate is 2% per year, the investment return is 5%, and the average tax rate is 25%, then the after-tax, after-inflation rate of return is 1.71%. Using the capital retention method, the capitalized value of Derek's family's income shortfall would be $2,028,070, calculated as $2,028,070 equals $2,890 per month times 12 months, divided by 1.71%. A more practical approach for needs that have a limited duration is to multiply the annual shortfall by the number of years the shortfall is expected. This is called the capital drawdown method. Case study. Derek has indicated that he would prefer that Becky would not have to return to work until Robbie turns 18. At that time, she could find work and likely take home enough money to cover all of her expenses. Using the capital drawdown method, the capitalized value of the family's shortfall over 18 years would be $624,240, calculated as $624,240 equals $2,890 per month times 12 months, times 18. Any other ongoing expenses, such as support obligations to a previous family, could be handled in a similar manner. Case study. Derek would like to ensure that his estate can provide spousal support to his ex-wife Susan of $500 per month for a maximum of 21 years, until Susan is aged 65. Using the capital drawdown method, this results in a capitalized value of $126,000, calculated as $126,000 equals $500 per month times 12 months times 21 years. He also wants to ensure that his child support obligation of $1,000 per month can be met for 11 years, until Jordan is 19 years old. Using the drawdown method, the capitalized value of these support payments is $132,000, calculated as $132,000 equals $1,000 per month times 12 months times 11 years. Capital needs analysis. The next step is to identify all of the other lump sum needs that may arise as a result of death, to ensure that the estate has enough liquidity to meet these needs. Other costs that may have to be considered as final expenses, funeral, burial, etc. Tax liabilities. Debts, mortgage and loans. Estate expenses, such as probate fees, and legal fees. Emergency fund, to establish a liquid reserve fund equal to 3 to 6 months of living expenses. Education fund, to pay the costs of post-secondary education. Estate equalization, to ensure heirs receive equal sums from the estate. Charitable giving. Final expenses. Final costs are the costs associated with a funeral, burial, cremation, visitation or remembrance services for the deceased. Case study. Derek has previously indicated that he believes that $20,000 will be sufficient to cover his final death expenses. Tax liabilities. It has been previously mentioned that upon death the deemed disposition of capital assets and the deregistration of registered assets, unless a rollover provision is used, can result in a significant tax burden. If cash is not available to cover the tax liability, assets in the estate may have to be sold to provide the required funds. Case study. Derek plans to leave all of his assets, with the exception of the cottage, to Becky upon his death. He would like to leave the cottage in trust to the children upon his death, and this will result in a deemed disposition for tax purposes. The cottage currently has an ACB of $250,000 and FMV of $600,000, which would result in a taxable capital gain of $175,000 if Derek died today, calculated as deemed proceeds minus ACB, times capital gains inclusion rate. Or $600,000 minus $250,000, times 50%. If Derek's marginal tax rate for the year of death is 45%, the resulting tax liability would be $78,750. Note that if the cottage continues to appreciate in value prior to Derek's death, which is quite probable given historical increases. This tax liability would be even higher. Debt elimination. A common objective in a life insurance needs analysis is to ensure that the estate has sufficient liquidity to pay off all debts owing at the time of death. Case study. Derek wants their mortgage of $330,000 and his car loan of $41,000 to be paid off if he dies. Estate expenses. The estate will need enough cash to pay expense incurred by an estate, such as probate fees, which can be as high as 1.5% of estate assets, depending on the jurisdiction. Compensation for the executor or estate trustee, often in the order of 1 to 3% of estate assets. Legal fees, dependent upon the estate's needs. Asset management fees, particularly if the estate consists of a large investment portfolio. Property maintenance fees, if the estate includes real estate. Case study. Derek feels that his estate is fair $330,000, and his brother has agreed to act as his executor without compensation. As a result, no provision has been made for estate expenses. Emergency fund. As a rule of thumb, a family should have liquid assets, equivalent to 3 to 6 months of expenses, available as an emergency resource. While the life insured can have accumulated a sufficient emergency fund, it can be easily consumed upon death by final expenses, income taxes or other estate expenses, which could leave the surviving family without an emergency fund safety net. Case study. Derek and Becky currently have $25,000 each in their TFSs, earmarked as their emergency fund, as well as $20,000 in their joint checking account. Their monthly expenses are $8,560, or $51,360 over 6 months, so their current emergency fund is adequate. However, they need to be careful that this does not get consumed by all of the expenses associated with Derek's death. Assuming that Becky's monthly expenses after Derek's death would be $4,150, as shown in the section Ongoing Expenses in the table, Summary of the family's monthly expenses, current and after death. Derek would like to ensure that 6 times this amount, or about $25,000, is maintained as an emergency fund. Education fund. The capitalized value of anticipated education expenses is often included in the life insurance needs analysis. Case study. As discussed in Chapter 10 Assessing the Client's Situation, Derek feels that setting aside $10,000 for each of their 3 children, in addition to their RESP, would be sufficient. He would like the capital needs analysis to include an education fund of $30,000. Estate equalization. Sometimes the assets in a deceased's estate that are to be shared among family members, that is, children, do not divide equally. Insurance can be used to help equalize the distribution of an estate so that from a value standpoint, each child receives an equal share of the estate. Case study. Suppose that Derek had decided to leave the cottage to Jordan only, perhaps because Jordan is the one who will likely use or enjoy it, or because Derek knows that Jordan, Anya and Robbie would not be able to manage it jointly without fighting, while the children in this case study are currently too young for these issues to arise. It is a common situation in other families. How would Anya and Robbie feel about their brother receiving sole title to an asset worth $600,000? Derek could perhaps alleviate conflict between the siblings if he bought sufficient life insurance to give $600,000 each to Anya and Robbie, thereby equalizing their treatment. Charitable bequests and legacies. A client may have special bequests or desires that they would like to do upon death, such as charitable giving, setting up a scholarship or endowment fund. These special bequests may be part of a tax strategy, or purely for philanthropic motivations. Case study. Derek has indicated that he would like to be able to donate $100,000 to the local hospice center upon his death. Total capital needs. Once all of the capital needs have been identified, including the capitalized income shortfall, a total must be calculated. Case study. Derek's total capital needs in the event of death are summarized in the table below. Summary of capital needs upon death. Capital needs. Amount. Capitalization of Becky's income shortfall $624,240. Capitalization of spousal support for Susan $126,000. Capitalization of child support for Jordan $132,000. Final expenses $20,000. Income tax on cottage transfer $78,750. Mortgage $330,000. Car loan $41,000. Emergency fund $25,000. Education fund, to supplement RESP, $30,000. Donation to hospice $100,000. Total capital needs $1,506,990. Assets available upon death. Keep in mind that many assets may exist, but they may not be immediately available to cover expenses. Even if cash or cash equivalents are available, the survivor may not wish to use them, preferring instead to keep cash on hand. A summary of the family's assets was developed in the chapter assessing the client's situation, and is repeated in the table below, but many of these assets are not available to meet estate needs. Becky is the beneficiary of Derek's Registered Retirement Savings Plan, RRSP, and his Defined Contribution Pension Plan, DCPP, and he believes they should be preserved for her own retirement. She will continue to live in the house, and the cottage is to be held in trust for their children. Presumably, she will keep his newer car and sell her van. This leaves a much smaller asset base of $402,750, as summarized in the following table. Total amount available for estate needs, $402,750. Existing insurance. A summary should also be made of existing insurance, its term, premiums, renewability and convertibility and, for permanent insurance, its cash surrender value, and ACB. Case study. Derek has an individual $250,000 10-year term life insurance policy that names his estate as the beneficiary. It is renewable and convertible until age 70. He is currently paying premiums of $240 per year, but the policy will renew in 2 years at age 49, with premiums of $1,125. Premiums and renewal at age 59 and 69 are $2,625 and $6,875 respectively. He also has $100,000 of coverage through his employer's group life insurance plan. Shortfall. The last step is to determine the shortfall in capital, which is calculated as capital shortfall is total capital needs at death minus available assets minus existing life insurance. This shortfall represents the amount of additional insurance that should be required. It is normally rounded up to the nearest $10,000 or $50,000 amount. Case study. Using a capital needs approach with the capital drawdown method, Derek's capital shortfall is $754,240, calculated as $754,240 equals $1,506,990 minus $402,750 minus $250,000 minus $100,000. Derek should therefore consider acquiring an additional $760,000 in life insurance. 11.4. Bringing it all together. Once the insurance agent has determined if life insurance is needed, the next step is to evaluate what options are suitable for the client. A few more factors should be considered before a recommendation is made to the client, such as duration of risk, investment needs, cash flow available to pay insurance premiums, additional coverage for spouse or dependents, duration of risk. The duration of each capital need helps determine whether permanent or term insurance is required. Not all risks are lifelong. For example, a mortgage has a fixed term, usually 25 years. Term insurance or a term rider on a permanent policy can best address risks in which a duration can be specified. Some risks create an obligation beyond the death of the life insured. For example, a disabled child may require care for his lifetime, which could extend for 30 years after the death of the life insured. The amount needed must be available when the life insured dies to ensure continued care. The need to pay taxes that arise on death makes a good case for permanent insurance. A proposed life insured may have a combination of risks for insurance to cover, some have a set term and some arise at death. Case study. Derek's capital needs may be term needs or permanent needs, as follows. Term needs. He wants to ensure that his family's income shortfall is covered until Robbie turns 18. After that time, he assumes Becky can support herself. His support obligation to his ex-wife, Susan, could last as long as 21 years unless she remarries prior to age 65. His support obligation for Jordan will last for 11 years. Their mortgage will be paid off in 25 years. Permanent needs. He would then like to be able to donate $100,000 to the local hospice center upon his death, regardless of when that death occurs. The tax liability on the cottage inheritance will not arise until his death, which hopefully will not be for another 30, 40 or even 50 years. Investment needs. Life insurance can be used as an investment for individuals looking for additional tax deferral opportunities beyond what is provided by an RRSP or TFSA. As well, life insurance can be used to transfer wealth to the next generation. Case study. Derek and Becky are not maximizing their RRSPs, and they are only making contributions to their TFSs in years when Derek has a bonus. Their only current investment program involves their RESP for the children. As a result, they do not appear to need additional investment opportunities. Cash flow versus premiums. The best policy or the best amount of coverage may not be affordable for the policyholder. Sometimes a trade-off will be needed between the ideal type or amount of insurance, and the cash flow available to pay the premiums. A convertible term policy may provide a short-term solution, and if income increases, the policy can then be converted to permanent insurance if the policy includes a conversion option. Also, if income fluctuates from time to time, a policy allows the policyholder to adjust the premiums to some degree. Case study. Remember, in Chapter 10 assessing the client's situation, it was determined that the family has current monthly expenses of $8,560, while Derek's take-home pay was $8,400 per month and his after-tax investment income was $600. As long as his non-registered investment portfolio continues to provide the same level of income, it appears that the family has about $440 per month to potentially spend for insurance purposes. Derek had also noted that his take-home pay might increase to $9,500 in 2 years, when he hopes to be promoted to Chief Operating Officer. This would increase their cash flow in the future. Coverage for spouse or dependents. If the rest of the family does not have sufficient life insurance coverage, or if cash flow is an issue, there may be an opportunity, and it may be more affordable, to cover them under the same policy. For example, some or all of the insurance could be done on a joint first to die or joint last to die basis on both spouses. The spouse and/or children could be covered under a family life rider. Case study. Derek and Becky do not currently have any insurance on Becky's life or on any of the children. Ideally, he would like coverage of at least $150,000 on Becky's life to help pay for childcare until the children are all in school full-time, and $10,000 on each of the children. 11.5. Making the recommendation. The next step is to assess the various life insurance options and make a recommendation to the client. Type of coverage. The agent must determine who the life insured will be, and the most appropriate type of policy based on the major risks as well as the appropriate term. More than one type of policy may be appropriate. If that is the case, riders can be added to supplement coverage or address specific needs. Case study. Derek's risks can be roughly categorized into 3 categories. Those that will disappear in about 10 years, child support for Jordan, car loan. Those that will disappear in 20 to 25 years, mortgage, income shortfall for Becky, spousal support. The tax liability on the inheritance of the cottage, which will be a permanent concern. The donation to the hospice, which will be a permanent concern. It would appear that Derek could use a combination of 20-year and/or 10-year term insurance policies to cover all needs except the tax liability on the cottage and the donation to the hospice. A cumulative cost comparison will be required to determine the most cost-effective option for him. Whole life insurance would be more appropriate than universal life for the tax liability and the donation to the hospice because at this point in time, Derek is not looking for additional investment opportunities and cash flow is limited. Note that while a joint last to die policy is often used to cover the tax liability on a family asset being left to the children, it is not appropriate in this case because the cottage is to be held in trust for the children. If Derek dies, there is no opportunity to roll it over to Becky and defer the taxable capital gain until her death. Therefore, all of Derek's life insurance should be on a single life basis. The coverage on Becky and children should be some form of term life insurance, and can be done via an individual policy on Becky with a child life rider, or as a family life rider on one of Derek's policies. Both options will be compared shortly. Death benefits. The agent needs to determine the appropriate death benefit. If multiple policies are proposed, each will have the death benefit specific to its policy objective. Case study. It has been determined that Derek needs a total of $760,000 in additional life insurance. This could be broken down as follows. While the taxability on the cottage is estimated to be $78,750 based on its current value, Derek is concerned the tax liability could be much higher because he expects the cottage to continue to appreciate in value. As a result, an amount of $200,000 for the permanent insurance policy would be appropriate to cover the tax liability plus the $100,000 hospice donation. Selecting the paid-up additions, PUA, option for any dividend payments would provide further protection against increasing cottage values. Of the other financial needs, 2 of them will end within the next 10 years, $132,000 in child support for Jordan and the car loan of $41,000. A $180,000 term TANE policy should be used to cover these needs. The balance of $380,000, $760,000 minus $200,000 minus $180,000, could be covered by either by a Term 20 policy, or a renewable Term TANE policy. A cost analysis should be performed to determine which it would be most cost-effective in the long run. Term coverage lasting, at least, 5 years is also needed on Becky's life, plus $10,000 term coverage on each of the 3 children. Derek also wanted to consider whether he should replace his existing $250,000 Term 10 policy before it is up for renewal in 2 years. Premiums. The premium for each policy and rider should be quoted, with the length of the payment period. The monthly and annual cost should be quoted, in addition to the cumulative cost of term recommendations. When premiums are too expensive, the following remedies are available. Reduce coverage. Consider convertible term instead of permanent. Look at underwriting factors that may have caused a higher premium. For example, could the life insured forego travel to Afghanistan? Look at the budget to see if other expenses could be reduced to free up more cash for premiums. Case study. Based on Derek's current age, health and smoking status, the following monthly rate would apply per $100,000 of coverage. Whole life with PUA, $325 for life. Term 10 renewable to age 85, $33 for first 10 years, $183 at age 57, $435 at age 67, $925 at age 77. Term 20 renewable to age 85, $60 for first 20 years, $540 at age 67. Cost of new insurance needed on Derek. For the cottage liability and hospice donation, the $200,000 of whole life insurance will cost $650 per month. Derek has total term insurance needs of $560,000, $760,000 minus $100,000 for the cottage minus $100,000 for the hospice donation. $180,000 of coverage for his shorter term needs, that is, child support and car loans will end within 10 years. $380,000, $760,000 minus $200,000 minus $180,000, in longer term needs, that is, spousal support, mortgage and Becky's income shortfall will end in about 20 years. So should Derek use renewable 10-year term, T10, 20-year term, D20, or a combination of both to cover these term needs? Performing a cumulative cost analysis can help if a table is constructed. At this point it is necessary to compare $560,000 of T10, option A, or T20, option B, renewable, dropping to $380,000 of coverage upon renewal, when his needs will have dropped. Remember, the premiums upon renewal will have already been set when he buys the policy. So given that Derek has 2 very distinct coverage periods, for example, 10 years and 20 years, and is certain that some of his insurance needs are short-term only, then a combination of T10 and T20 policies will be more cost-effective in the long run. However, if he feels that his insurance needs may remain the same or even increase in the future, he may want to consider covering the entire amount with a single T20 policy. Note that while spreadsheets help illustrate the point, the cumulative cost comparisons can usually be done very simply using a calculator, as follows. Option A. Single $560,000 renewable T10 policy, dropping to $380,000 after 10 years. First 10 years equals $22,176. Second 10 years equals $83,448. Cumulative cost over 20 years equals $22,176 plus $83,448 equals $105,624. Option B. Single $560,000 T20 policy, dropping to $380,000 after 10 years. First 10 years equals $40,320. Second 10 years equals $27,360. Cumulative cost over 20 years equals $40,320 plus $27,360 equals $67,680. Option C. $180,000 T10 policy for 10 years, plus $380,000 T20 policy for 20 years. T10 policy equals $7,128. T20 policy equals $54,720. Cumulative cost of 20 years equals $7,128 plus $54,720 equals $61,848. Replace Derek's existing $250,000 policy. Derek has an existing $250,000 Term 10 policy that is due to renew in 2 years. He was shocked to realize how much the premiums will increase upon renewal, from $250 per year to $1,125 per year. Derek heard that it is often cheaper to shop for a new policy, rather than renew the old one, so he asked his agent to determine the cost of replacing his old policy. The results are provided in the table below, which shows that Derek would be better off keeping his existing policy. The reason the results were disappointing for Derek was that he became a smoker after the original policy was issued. The old policy will remain valid, even though Derek is now a smoker. This is one of the reasons premiums jump so much upon renewal, because the life insured may no longer be in the fine health he was when the policy was first issued. Cumulative cost comparison. Existing and new $250,000 policies. Insurance for Becky and the children. Derek wants to obtain $150,000 of life insurance coverage on Becky's life, and $10,000 on each of the children. This can be accomplished in one of two ways. Buying a standalone $150,000 Term 10 insurance policy on Becky, with a $10,000 child life rider, which would have a total monthly premium of $23.54. Adding a family life rider to his whole life insurance policy, with $150,000 of Term 10 coverage on Becky and $10,000 each on the children, which would have a total monthly premium of $19.04. The standalone policy is more expensive because it has a separate policy administration fee. This fee is not charged when the coverage is added as a rider to Derek's whole life policy. Total costs. The total monthly cost of the recommended additional insurance is $596, or $200,000 whole life policy on Derek $650. Family coverage rider of $150,000 on Becky and $10,000. On each child $19. $180,000 Term 10 on Derek $59. $380,000 Term 20 on Derek $228. Total $956. This exceeds the $440 the family currently has in available cash flow, so they will have some decisions to make. A few of the possibilities include reducing the amount of coverage, and accepting the fact that Becky may have to return to work before Robbie turns 18, and Derek will not be able to leave $100,000 to his favorite charity. Obtaining term insurance with a conversion option for the tax liability on the cottage and the hospice donation, which would allow Derek to convert to permanent insurance once cash flow permits. Scaling back on their other expenditures to increase the amount of cash flow they can devote to life insurance. Depending on the policy of their insurance company, Derek may be able to apply for a decrease in premiums if he is able to stop smoking for at least a year. Beneficiaries. Based on understanding the client's situation, the agent may be able to recommend how the beneficiary designations should be structured, for example, revocable or irrevocable. Primary and contingent. A primary beneficiary receives the death benefit so long as they survive the life insured. More than one primary beneficiary can be named. Multiple beneficiaries share the death benefit equally unless the policy has assigned a set dollar amount to each beneficiary. beneficiaries can include the estate of the policyholder, when the purpose is to pay the tax liabilities on the estate. The surviving spouse, if the funds are used to replace a source of income. Any person the policyholder chooses to name. A trustee for minor children, if the funds are to be used to support a minor child. Case study. With his $180,000 term life insurance policy, Derek could name Becky the beneficiary of $50,000 in order to reimburse his car loan and a testamentary trust as the beneficiary of $130,000, to provide child support for Jordan, with any remaining amount to be paid to Becky when Jordan turns 18. It is good practice to name contingent beneficiaries. A contingent beneficiary receives the death benefit if the primary beneficiary has died. If the contingent beneficiary has died, the death benefit is paid to the estate of the life insured. Case study. If Derek names Becky as his beneficiary, he may want to name a testamentary trust for the children as a contingent beneficiary. If he and Becky die simultaneously, this will keep the funds from being part of his estate and being subject to probate. Revocable or irrevocable. In most Canadian jurisdictions, beneficiary designations are automatically revocable unless the application specifies otherwise. In Quebec, if the policyholder designates his spouse as the beneficiary, it is automatically irrevocable, unless the policyholder specifies that it is revocable when he first designates the spouse as his beneficiary. Naming an irrevocable beneficiary effectively puts control of the policy into the hands of the irrevocable beneficiary. An irrevocable beneficiary may be suitable when the policyholder is named in a spousal or child support court order. Creditor protection is needed. A tax strategy in connection with charitable giving. Probate implications. A death benefit that is paid to the estate becomes subject to probate fees. Probate fees do not exist in Alberta or Quebec. It is good practice to name a beneficiary to avoid the death benefit being subjected to probate fees. Also, when an estate is subject to probate, the contents of the estate and the terms of the will become public knowledge. Probate fee varies across jurisdictions. The highest is 1.5%. The desire to avoid probate should never be a substitute for good planning. Highlighting important clauses. When reviewing a new policy, the life agent should ensure that the policyholder is aware of, and understands, certain key provisions. These are covered in more detail in the module Ethics and Professional Practice. Exclusions. The agent has a responsibility to review any policy exclusions with the client and ensure that the client understands that the death benefit will not be paid under those circumstances. All policies have a 2-year exclusion period for death by suicide after the policy issue date, or date of reinstatement for which the death benefit will not be paid. Example. Anne-Marie is an avid photographer and frequent traveler. When the insurance company inquired about her travels, she had disclosed that her most recent places of travel included Ethiopia, India, and South Africa. The policy was issued with an exclusion for death while traveling to Ethiopia, because of the perceived high incidence of disease and conflict at that time. The death benefit will be paid as long as her death does not occur in Ethiopia, and cannot be linked to an illness acquired from her travels there. Incontestability. For the first 2 years of the life insurance contract, the insurance company can reevaluate its underwriting of the policy. This is called the contestability period. The discovery of a material mistake in the first 2 years of the policy by the insurance company can lead the company to void the policy, adjust premiums, add an exclusion. Once this contestability period has expired, the policy is said to be incontestable and the insurance company cannot cancel the policy for any reason other than missed premiums, or fraudulent misrepresentation. Fraud voids a policy at any point it is discovered. If a policy has been cancelled, it can be reinstated by paying all outstanding premiums and any interest. There is also a requirement to prove insurability. Once a policy has been reinstated, the 2-year contestability period begins again. Grace period. The grace period is the 30 or 31-day period after the premium due date. The premium must be paid before the end of the grace period or else the policy lapses, is cancelled. The death benefit, minus the unpaid premium, is paid if death occurs during the grace period. Reinstatement. As noted above, reinstatement of a policy may be possible when missed premiums plus interest is paid and evidence of insurability is provided. A reinstated policy is preferable to a new policy because its premiums will be based on the life insured's age when the policy was first issued. A new policy will be based on the life insured's attained age at the time the new policy is issued. Example: Barry bought a $250,000 20-year renewable term life insurance policy when he was 38 years old, and the policy premiums were $35 per month. When Barry was 50, he missed several monthly payments in a row and the policy lapsed 31 days after the first missed payment. When he discovered his error, Barry considered buying a new life insurance policy. He was shocked to learn that the premiums on the new policy would be $150 per month because the premiums would be based on his current attained age of 50. Fortunately for Barry, he was still in excellent health, and he was able to reinstate his old policy by paying the $105 in missed premiums, plus accrued interest. Right of rescission. There is a 10-day period following delivery of the policy in which the policyholder can change his mind, and receive a full refund of the premium he has paid. Expiry. All term policies have an expiry date at which point the coverage will cease. Surrender charges. A surrender charge may be applied to a UL policy if it is cancelled or a partial withdrawal is taken. The insurance agent, to ensure that the client understands the surrender charges that may be applied, a partial withdrawal is made or if the policy is cancelled. 11.6. Using illustrations. Illustrations often accompany the application so that the insurance company's underwriters have a clear understanding of the insurance coverage being requested. They show policy benefits and features in a table or similar format. A term policy illustration shows the premium and death benefit for each year of the policy. A permanent policy illustration shows the premium, death benefit, dividends, mortality deductions, investment account values based on minimum and maximum deposits, and cash surrender value for each year of the policy. Policies that are sensitive to investment performance will show at least two scenarios based on different rates of performance. The scenarios are not predictions of performance, just possibilities. The policyholder signs the illustration as evidence that he understands what it shows. Chapter 12, Ongoing Service. 12.1. Monitoring changing client needs. The need for insurance may change over time if personal circumstances change. Thus, the life insurance agent will need to provide ongoing service for clients. Some life events that may impact insurance needs are: new dependents, marriage, divorce, employment changes, new mortgage, acquiring a business, leaving Canada, and update needs analysis and appropriate recommendations. New dependents. An addition to the family, such as a new baby, usually increases the requirement for insurance coverage. The life insured will want to ensure that their estate will be able to provide for that dependent in the event of his or her death. There is another person to consider in the estate planning process. A parent may wish to insure the new family member by either buying a new policy or by adding a family rider to an existing policy. A baby is automatically covered under existing policies that have a family rider 15 days after birth. Marriage. Marriage may call for the following insurance-related changes: obtaining a new policy on the life of a new spouse, changing the beneficiary designation in an existing policy to the new spouse, an increase in the death benefit of an existing policy to ensure that enough financial support can continue in the event of the life insured's death. Divorce. Note that divorce automatically revokes an ex-spouse's entitlement under an existing will. It does not automatically revoke beneficiary designations, except in Quebec where a pre-divorce beneficiary designation on a life insurance policy is nullified upon divorce. In all other jurisdictions, divorce may call for the former spouse to be changed as beneficiary. If spousal support is required as part of a settlement agreement, often the agreement will specify that a spouse obtain a life insurance policy to ensure that the support obligation continue to be satisfied in the event of that spouse's death. To protect the recipient spouse or child, additional conditions may be imposed as part of the agreement, such as the spouse cannot allow the policy to lapse or that the beneficiary designation must be irrevocable. Employment changes. Whenever there is a change in employment, insurance needs should be reviewed. A change of employer suggests a comparison of the previous group coverage with the new group coverage to identify whether there are any declines or gaps in coverage. An opportunity to convert group coverage to an individual policy, usually within 30 days of leaving the group plan. A change in income suggests A review of the amount of insurance coverage that is in place when the insurance needs have been determined based on the human capital approach. A change in job function suggests the possibility for an improvement in premium rating. New mortgage. A lender may require insurance on a mortgage as a condition of the mortgage. Families may opt to buy a personally held insurance policy with enough coverage to pay off the mortgage to the lender in the event of the death of an income-earning spouse. Acquiring a business. A person who starts a new business, buys a business, or buys into a business or partnership will want to buy life insurance to ensure appropriate coverage is in place for a buy-sell agreement or for a key employee. Protect wealth from creditors, or use as collateral, if needed, to secure a business loan. Leaving Canada. A policy review is essential if there will be a relocation or move abroad that will cause the individual to cease from being a Canadian resident. Some policies are only valid if the life insured is resident in Canada. Also, some policies may include an exclusion if death occurs outside of Canada. Updated needs analysis and recommendations. Whenever there is a change in the circumstances of the policyholder or the life insured, the agent should review the previous needs analysis. It should be revised to reflect all changes in the policyholder's situation. In other words, the needs analysis must be based on current needs, not outdated needs. Changes that may need to be addressed include replacing a policy, converting a policy from term to permanent, revising a policy to include riders, modify coverage or lives insured, changing the beneficiary designations. 12.2. Amending a policy. 1. There are two categories of changes that could be made to an existing life insurance policy. 2. Those that require underwriting, and 3. Those for which underwriting is not required. Administrative changes. Administrative changes do not change the underwriting on the policy. A policyholder can make changes by contacting the insurance company. Such changes include changes in name of the policyholder and beneficiaries, due to marriage or divorce. Mailing address change. Beneficiary designation changes. Change to frequency of premiums. Changes to investment fund choices. Changes requiring underwriting. Underwriting must be involved for the following types of changes: adding a life insured, adding riders and or supplementary benefits, increases to the coverage, change to the type of death benefit, changes in risk factors such as health or lifestyle categories, changes to the dividend option on a par policy or to paid-up additions. 12.3. Renewing a policy. A renewable term policy will renew at the end of its term automatically. Does not require evidence of insurability. Provide a schedule of guaranteed renewal rates when the policy is issued, and increase premiums to reflect the age of the life insured on the renewal date. Example: Kevin bought a $500,000 10-year renewable term insurance policy when he was 35 years old, and the initial premiums were $450 per year. The policy will automatically renew at age 45, 55, and 65, with annual premiums of $2,250, $5,250 and $13,700 respectively. Renewable policies are more subject to adverse selection than other types of policies. This leads to the guaranteed renewal rates being higher than if the policyholder were to obtain a new policy. Adverse selection is when those who would not qualify for a new policy are more likely to renew the policy than those in good health. 12.4. Replacing a policy. Life insurance agents face a potential conflict of interest due to the commission they earn when a new policy replaces an existing policy. Life insurance agents have a fiduciary duty to the client that requires the recommendation of a policy replacement to be in the best interests of the policyholder. Churning and twisting. An agent must not misrepresent, provide incomplete information, or make incorrect statements to a policyholder to convince him to replace one policy with another, or use the cash value from one policy to buy another. Doing any of the above is a breach of the life insurance agent's fiduciary duty. The following two deceitful practices are prohibited by life insurance agents. Churning occurs when a policyholder is persuaded to replace one policy with another at the same insurance company. Twisting occurs when one policy is replaced with another at a different insurance company. Disclosure requirements. In most jurisdictions, A policy replacement requires the policyholder to sign a life insurance replacement declaration, LIRD, form. The LIRD asks questions about the existing policy as well as the advantages and disadvantages of the new policy. The LIRD must be accompanied by a written explanation about the reasons for the policy replacement, the benefits the policyholder will receive from the new policy, and a description of any situation when benefits might not be paid under the new policy. In Quebec, the Notice of Replacement of Insurance of Persons contract is used instead of LIRD. Canceling the contract being replaced. The new policy must be issued, delivered and accepted before the old policy is cancelled. Otherwise, a gap in coverage could occur. If the old policy is cancelled too soon and temporarily leaves the life insured with no insurance coverage, if the life insured were to die during the period of no coverage, there is no death benefit to be paid. 12.5. Canceling a policy. The policyholder may cancel a policy whenever he chooses and for whatever reason, such as he no longer needs the protection. He needs a different type of policy. He could obtain a better rate with a new policy compared to renewing the existing policy. He can no longer afford the premiums. Not paying premiums will cancel a term policy immediately. A whole life or a universal life policy with cash value may not be immediately cancelled if the cash value is used to make the premium payments. It is better for a policyholder to cancel the policy in writing by providing all pertinent details such as the policy number to ensure the cancellation occurs as desired. A prorated portion of premium paid may be refunded at the time of cancellation. 12.6. Surrendering a policy. A policyholder's cancellation of a whole life policy or a universal life policy is commonly referred to as fully surrendering the policy. Upon surrender, a policyholder gives up all rights, including the death benefit, under the contract. Withdrawals from a policy's cash surrender value is considered a partial surrender of the policy. With partial surrenders, the policy remains in effect and the death benefit will be paid if the life insured dies after the withdrawal. However, a partial surrender may result in a policy taxable gain upon which the policyholder would be taxed. 12.7. Policy assignments. A policyholder can choose to assign some or all of his rights under an insurance policy to another party. Absolute policy assignment. An absolute policy assignment transfers legal title and all rights and obligations of the policy from the policyholder to the assignee or recipient, relinquishing all further control or financial interest in the policy. The policy typically specifies the requirements for completing an absolute assignment. An absolute assignment is considered a deemed disposition which could lead to taxable income for the policyholder. Partial policy assignment. In all of Canada, except Quebec, the use of a life insurance policy to secure a loan requires the policyholder to execute a collateral assignment. This takes the form of a partial assignment, where the policyholder continues to own the policy but is restricted from any actions that could reduce the value of the policy, such as making a withdrawal. When the life insured dies, if the loan is still outstanding, the lender has first rights on the death benefit, up to the amount of the loan outstanding. In Quebec, a movable hypothec is required to use a life insurance policy to secure a loan. It does not involve the transfer of policy ownership but gives the lender rights in the policy to the extent of the loan balance. It can only be used by businesses. The loan must be for business purposes. 12.8. Claims process. When the life insured dies, the beneficiary or the estate, if no beneficiary is named, becomes the claimant and comes forward to receive the death benefit. Agent's role. The life agent's role is to assist with the claims process in a timely and sensitive manner. This may include providing and filling out forms as well as choosing settlement options. It is important that the agent not give the claimant the impression that the agent is the one who decides whether the claim will be paid, or that payment is guaranteed. Completed claim form. The agent may provide the claim forms and help the claimant complete the forms. The completed forms and additional required documentation are sent to the claims examiner at the insurance company. Policy status. One of the first things the claims examiner must do is verify that the policy was in force when death occurred. The policy may not be in force and hence any death benefit will not be paid if the policy lapsed, was surrendered, or expired, in the case of a term policy. Proof of death. Proof of death must accompany the claims forms and is used to ensure that the deceased was the life insured under the policy. Proof of death is usually provided in the form of one or more of a death certificate, a funeral director's certificate, or a coroner's report. Letters probate. The claims examiner may request a copy of the life insured's probated will if the estate is named as the beneficiary of the policy. A probate will also be requested if the named beneficiary is deceased. As part of the probate process, a letters probate is issued by a court which verifies that the will of a deceased is valid and that the executor has the authority to administer, act on behalf of, the estate. If the life insured dies without a will, the court appoints an administrator and issues letters of administration which confirm the administrator authority. Probate fees are a charge against the estate when letters probate and letters of administration are issued by the court. In Quebec, the claims adjuster will request a copy of the notarial will and the will search certificate which establishes that the will received is the last will and testament of the deceased. If the will is handwritten or made in the presence of witnesses, it must be probated by a notary or by the Superior Court of Quebec, who, upon completion of the probate process, delivers a certified copy of the will. If the insured dies intestate, the legal heirs are the liquidators of the succession. The claims adjuster will request a notarial declaration of heirship and/or the appointment of liquidators, which must be obtained from the court or a notary. The costs of obtaining these documents are the responsibility of the succession. Attending physician's statement, a PS. Usually, in the case of large claims, an attending physician's statement, a PS, will be requested to confirm the cause of death and verify the medical information that was used to underwrite and issue the policy. If the cause of death is suicide and the suicide occurred within the 2-year suicide exclusion period, the claim will be denied and the death benefit will not be paid. If death was the result of an activity or cause listed in the policy as an exclusion, the claim will be denied and the death benefit will not be paid. Proof of age and gender. A birth certificate may be requested to prove age and gender. A discrepancy in age from what was reported on the application may result in an adjustment of the death benefit. Confirmation of beneficiary. The claims examiner will need to confirm that the claimant is the beneficiary named in the policy, as on record at the insurance company, or as directed in the will of the policyholder. If a named beneficiary has died before the claim is made for the life insured, the claim examiner will require proof of death before the death benefit is paid to the contingent beneficiary, or estate if no contingent beneficiary has been named. When a class of people is named as beneficiary, the insurance company will ensure that all members of the class have been identified before the death benefit is paid out. For example, naming all my grandchildren will require all grandchildren to be identified to ensure that they are all alive and all included in the distribution. 12.9. Group life insurance claims. Group life insurance claims are processed in much the same way, only the plan's administrator, rather than a life agent, will facilitate the claims process. In the case of an employer-sponsored group plan, the claims examiner will confirm that the deceased person was in fact covered under the plan. He may not be covered if he had yet not satisfied the plan's waiting period, or if he had terminated employment prior to death. Group creditor insurance may be subject to post-claim underwriting. 12.10. Factors that could vary the payment upon death. It is possible for the amount paid out to the beneficiaries upon death could be more or less than the policy's face amount due to a number of reasons. Participating whole life policies. Depending on the payment option selected when the policy was set up, participating policy dividends can affect the death benefit. Paid-up additions will permanently increase the death benefit every time a policy dividend is issued. The accumulation option will increase the death benefit, provided funds are not withdrawn. The term option will temporarily increase the death benefit for the duration of the 1-year term. Adjustable whole life policies. With an adjustable whole life policy, the death benefit and premiums are guaranteed for a specified period. After the guarantee period ends, the death benefit may be increased, decreased, or stay the same depending on the insurance company's experience. Universal life policies. Universal life policies have several death benefit options, including a level death benefit, death benefit plus account value, death benefit plus cumulative premiums, index death benefit. The death benefit can be larger than the face amount depending on the form of death benefit selected by the policyholder, deposits, and investment returns. Misstatement of age. At the time of the claim, if the insurance company discovers that the insured's age was fraudulently misstated on the application, the policy will be voided and the claim will be denied. The onus is on the insurance company to prove that the misstatement was fraudulent. However, if the misstatement of age was a mistake, the death benefit will be paid but will be adjusted the appropriate coverage that, based on premiums paid, would have been purchased. In Quebec, a policy is not voided by misstatement of age. The death benefit is adjusted. Example. When Paul was 45 years old, he bought a $100,000 10-year term life insurance policy, with an annual premium of $230. Paul died 4 years later, at age 49. When processing his death claim, the insurance company noticed that there was a mistake on Paul's application, which had led them to believe he was only 40 years old at the time of issue. However, the annual premium for someone aged 45 at the time of issue is $324. Ignoring any annual policy fees included in the premium, this means that the insurance company would pay a death benefit of $70,988, calculated as $70,988 equals $230 divided by $324, times $100,000. This is the amount of coverage that Paul's premiums of $230 would have purchased if the insurance company had known he was 45. Misstatement of gender. Like misstatement of age, a policy will be voided if it is discovered at the time of the claim that the insured's gender was fraudulently misstated. The onus is on the insurance company to prove that the misstatement was fraudulent. If the misstatement was not fraudulent, the death benefit will be adjusted to what would have been paid based on premiums paid. Example. When Leslie was 35 years old, she bought a $100,000 10-year term life insurance policy with an annual premium of $62. When he died 3 years later, the insurance company discovered that his gender had been entered as female when the policy was issued, so the annual premium he was paying of $62 was lower than it should have been. Premiums for a 35-year-old male would have been $80. Ignoring any annual policy fees included in the premium, this means that the insurance company would pay a death benefit of $77,500, calculated as $62 divided by $80, times $100,000 equals $77,500. This is the amount of coverage that Leslie's premiums of $62 would have purchased if the insurance company had known at the time of issuing the policy that he was male. Policy assigned as collateral. When a collateral assignment has been made and the life insured dies, the insurance company will pay the outstanding balance on the loan from the death benefit to the lender and pay the remaining balance to the beneficiary. Outstanding policy loan. When a policy loan has been taken from the cash surrender value of a policy and the balance is still outstanding at the time of the insured's death, the death benefit is reduced by the outstanding amount of loan plus accrued interest. Example. Marva has a $500,000 whole life insurance policy, and 3 years ago she took a policy loan of $100,000 against the policy's cash surrender value, with interest at 4.5% compounded annually. She has not paid back the loan nor paid any interest over the past 3 years. If she dies today, the death benefit will be reduced by $114,117, calculated as $114,117 equals $100,000 times 1.045, year 1, times 1.045, year 2, times 1.045, year 3. This is the original policy loan plus compound interest calculated as year 1, $100,000 plus 4.5% times $100,000, or $104,500. Year 2, $104,500 plus 4.5% times $104,500, or $109,202.50. Year 3, $109,202.50 plus 4.5% times $109,202.50, or $114,116.61. As a result, her beneficiary would receive $385,883 calculated as $500,000 minus $114,117 equals $385,883. Unpaid premiums. When a premium has been missed and the life insured dies during the grace period, the death benefit is reduced by the amount of the unpaid premium. Example. Joshua had a $250,000 term life insurance policy, with annual premiums of $3,300. He has been hospitalized for the last 2 weeks after suffering a serious heart attack, and as a result, he forgot to pay the premium when it came due last week. If Joshua dies today, the insurance company will still pay the death benefit, but the amount will be reduced to $246,700, calculated as $246,700 is equal to $250,000 minus $3,300. 12.11. Settlement options. The lump sum payment is one settlement option. However, there are others such as a term certain or life annuity which pays a fixed amount of income for a specified period of time or for life, depending on the type of annuity. Annuities are discussed in more detail in the Segregated Funds and Annuities module. The agent can provide these options when the claim is made. 12.12. Time requirements. A claim can be made any time after death. As long as the policy was valid at the time of the life insured's death, the death benefit will be paid plus interest. There is no requirement that the life insurance company pay the death benefit within a certain time. 12.13. Tax treatment of death benefits. The death benefit of personally held life insurance is received tax-free by the beneficiary and does not create taxable income for the deceased. The death benefit includes the entire amount. The death benefit of a group life insurance policy is received tax-free by the beneficiary and does not create taxable income for the deceased, regardless of whether the employee or the employer paid the premiums. When life insurance is owned by a corporation, the death benefit is received tax-free by the corporation and is credited to its capital dividend account. The corporation, as instructed by the board of directors, pays out a tax-free dividend from the capital dividend account to